In this presentation, we will discuss financial statement analysis, including ratio analysis, vertical analysis, horizontal analysis. This will be a long presentation. If you would like to jump to relevant points within it, take a look at the description below, which will have links to those relevant points, as well as links to the playlist and a description of what will be included within them. In this presentation, we will discuss the purpose of financial analysis, including the users of financial analysis, the common categories of financial analysis in terms of what the goals of that analysis is, and common ratios that are used to achieve those goals. Users of financial analysis include both external and internal users. So both people outside of the company will use analysis, as well as management within the company that's going to use the analysis. Remember that external users, such as a bank that might want to give a loan, or investors, are typically looking at the company as a whole to see the condition of the company, to see whether they want to take action or do business with the company, possibly finance the company in some way, or possibly invest in the company. The internal users, management, are going to use the ratios in a similar fashion, but this being from an internal use standpoint to help with the decision-making processes for the company, to get the health of the company, to see where they can improve. So both external users and internal users will use this type of analysis in order to gauge the health of the company, although the objectives might be different. External users trying to decide whether or not they want to do business oftentimes with the company or invest in it. Internal users are going to be looking to improve the operations of the business. The reason for financial analysis is to evaluate performance and financial conditions. So we want to see how the company is doing in terms of performance. We want to see how the company is looking at this point in time. And of course, you can consider the financial statements themselves when you consider these goals. That's in essence what we're compiling the financial statements to do. In other words, the income statement is typically giving us performance information, as well as the statement of cash flows, what's happening over time. These are temporary accounts lined up to give us an idea of how the company did over a certain time period. Then we have the balance sheet, which is going to tell us where we stand at a particular point in time. What's our financial condition as of this point in time? Using those tools, the financial statements, then we can break them down further using the financial statement analysis to further get those same kind of goals that we're trying to get just from the financial statements themselves through things like ratio analysis. So we want to look at past and current performance. We want to see how did they perform in the past, how are they performing currently, and of course we're looking for trends that might help us to think how are they going to perform in the future. So when we're considering performance, we're thinking about how are they doing in terms of action, as opposed to how are they at this point in time in terms of a financial condition, in other words, past and current performance, we're typically thinking of income statement items, performance items, temporary accounts, as opposed to the balance sheet. Where are they at this point in time? Then we want to think about their current financial position. This time we're typically thinking about the balance sheet. Now remember, the balance sheet represents the end of the time period. So we're usually saying the balance sheet is as of a point in time, as of now, or as the latest point that the financial statements were created. And we want to take a look at where they stand at this point in time and consider things like, are they solvent? Can they pay off their debt? How are they looking from a financial condition in terms of their assets and liabilities? And so that's going to be a balance sheet type of setup. So remember, those two things are going to be different, because when we think about performance, we're thinking about how they're doing. When we think about the financial condition, in other words, it's quite possible for someone to be in a pretty good financial condition and still be performing not too well. And that could be because they've got some money in some case, possibly from past performance, way past in the past or something like that, or from a substantial amount of investments, and therefore their balance sheet might actually look good, and yet their performance not look great. Or vice versa. We might say, hey, their performance is looking pretty good. It's just that their balance sheet at this point in time doesn't look good. And so if it was the case that their financial position was looking better, then their performance possibly could look quite good. And so those are the type of analysis that we want to basically consider, and the types of questions we want to consider. And as we do, always just basically go down to what are the reasons for these two statements in general, to get a sense of what we're looking at. So obviously, again, income statement accounts, performance, how are we doing, timing, condition, that's the stopwatch to see how fast we're running, how much revenue are we generating over a certain period of time. The balance sheet, that's more like we're sitting at this point in time, how do we look just in terms of the big picture at this point in time. Ratios will help us to extentuate that kind of analysis and make it more detailed and give us more information about those main goals. Then we want to take a look at future performance risk. As we consider these two items, we're considering, where they sit at this point in time, the balance sheet, and we're considering what their performance is. Then we can look into the future and say, okay, how much risk is there in the future in terms of performance? And we can start to think of ratios and analysis to project into the future. And of course, that's our goal. We're looking into the past. How did they do in the past? How are they standing right now, just from a financial condition? Are they strong? Do they look strong? Do they have a lot of assets versus the liabilities, or are they solvent? And then we project out into the future and say, well, what do we want to do in the future? Management, internal management, then saying, how could we improve? How can we look better all the time? And of course, external users, investors, financiers are asking questions like, do I want to do business and or invest, be associated with be part of this business? And of course, to make that decision, you have a future orientation, projection into the future on how the business will do. Groups of ratios. Really important to think about the groups of ratios, because oftentimes we think of these ratios and we say, those are good ratios. I could see how they're useful and whatnot, but we want to know exactly what the ratio is trying to do, so that when we calculate the ratio, we know what it's doing. It's very easy, especially if we're just learning these in terms of school conditions, for us to kind of learn the ratios and not really know what they're doing, but just go through the mechanics of making them. This happens in work, job-related areas as well, where we're just saying, we just mechanically put the numbers into this ratio analysis and it spits out the numbers for us, and we have no idea what it means. The more difficult part here is, of course, to know what it means. We can make computers and whatnot to spit out the ratio. We need to understand the ratio, look at the ratio, and then basically know what it means. Also note that in test questions, very common test questions are not just going to say, here's the ratio, but they're going to say, what's it for? What's the category that it's basically for? And then try to group things up in that way. And that's one of the most confusing things to kind of get, because you're always going to say, yeah, I know that ratio. I may even know how to calculate it. I know the formula for it, but I'm not quite sure what category it falls into in terms of the grouping. And that's a common place where many learners that are taking formal schooling are going to be tested on this information, fall short and have problems with. So every time you look at these ratios, if you're going to go through multiple choice questions for sure, and just in general, so that you know what's going on in terms of practice, so you know what the ratio is doing, you want to know what the group is, number one, and then you want to basically look at the ratio and say, what is this ratio doing? How is it helping me? You always basically want to go back and ask that question. It'll become more and more clear, and then think about the types of things that could have changed in order for the ratio to change, to compare one set of data to another. So we have the groups including liquidity and efficiency. And remember, every time you hear the word liquidity, you're thinking about how liquid something is. You can think about it in terms of assets, how close to basically cash something is, how liquid the assets that are there are. Typical kind of comparison is going to be like property, plant, and equipment, not very liquid, versus cash or something like accounts receivable, which are going to be more liquid. Then we talk about solvency, and that's going to have to do with how likely is the company, or what condition are they in order to pay off their debts. Are they able to, keep on going? Are they a going concern? Can they pay off their current liabilities or their current obligations? Then we have profitability. We can think of that in terms of basically the income statement. How are they doing in terms of performance? What are their timing accounts looking like? Are they doing well in terms of performance standpoint, revenue and expenses? How are they doing? Are they profitable? Then we have market prospects. As we consider market prospects, we're often considering things within the market, such as the market price. In other words, if we sell stocks, often we're considering stocks that are publicly traded, although we can do some of these kind of ratios for non-publicly traded stocks as well. But if we're thinking about publicly traded stocks, we know it has a market price, and the market price is known because it's being exchanged on the stock market. Note that the market price, things like the market price, are driven by the market, are not necessarily on the financial statements, but we can use those market indicators in order to do some analysis on the financial statements. We also might do some analysis with relation to the return that is happening, the dividends, and we might be comparing things like dividends, the return, money going back to the shareholders with regards to the investment, which might be things like the market price. So whenever we consider the market perspectives, remember that that's something that's going to be kind of outside a lot of times from the financial statements. We're looking at what's being traded in the market. It's still data that is, of course, available, because if it is publicly traded, it's being traded on a market, then we'll have some of that market perspective in terms of the market prices, and we can work those into our analysis. Typically, an analysis is going to be based on the value of the stock as compared to the current market value of the stock as compared to some of the internal analysis. What tools are we going to use? Obviously, we're going to be using the financial statements, and the core financial statements that we're going to be using are going to be the income statement and the balance sheet. Now, we're going to be using the current income statement and balance sheet mostly, but we're going to draw a little bit possibly from the prior year income statement and balance sheet as well. In other words, it's useful to have the current balance sheet and income statement, or the current financial statements, and the prior year financial statements, especially for some of the ratios. So that's going to be our primary tools. And then obviously we have the statement of stockholders' equity, part of the financial statements, and the statement of cash flows. So these are going to be the financial statements that we're going to be using in order to conduct our ratio analysis. We're also going to have within those financial statements the notes to the financial statements, which can give us more detail in terms of our analysis. So much of our ratio, our calculation type of analysis, will be on the actual financial statements themselves. Mainly the main two, the income statement and the balance sheet, all four, of course, being part of the financial statement analysis that we can use ratio analysis on, and then we can get some more detailed information from the notes to the financial statements. Notes to the financial statements, of course, being there when we're considering especially publicly traded stocks. Now we'll go through a list of ratios, and we're going to go through them by category. So we're looking at the liquidity and efficiency ratios, and you want to start to think about these ratios by category, because once again, that's just a common type of matching question or something like that. It also gives you an idea of, what these ratios are actually doing, what's the question it's trying to answer, and that'll help you as you go forward to actually conduct the ratios. Typical types of questions within practice and within test questions are then to interpret the ratios. And we'll do a little bit more of that type. We'll calculate the ratios and think about what they mean in future presentations, but just realize that that's going to be more of the difficult kind of component. We're going to see this difference, this change, then we got to interpret it in some way. That's got to be more than, well, the denominator went up and the numerator went down, and therefore, we're just telling us what the numbers did. So we have to have some more insight to that, and the first step to that is say, okay, what is this ratio trying to tell us? And then look at the ratio and then consider the changes that could have happened within the company. So liquidity and efficiency, one of the most common ratios is the current ratio. We're just going to list them out here, and then we'll go through them future presentation. The acid test ratio, the accounts receivable turnover ratio, the total asset turnover, the inventory turnover, the days sales uncollected, days sales in inventory. Then we have solvency type ratios within the solvency group. And by the way, this group is going to be the largest group. So liquidity and efficiency, largest group. Solvency ratios, we've got the debt ratio, the equity ratio, the debt to equity ratio, and the times interest earned. Then we have the profitability category. Within profitability, we have the profit margin. We have the return on total assets. We've got the return on common stockholders' equity. And then finally, we have the market perspectives, and within the market perspectives, we have the price earnings ratio, and we have the dividend yield ratio. In this presentation, we will discuss types of financial statement analysis, the most common types of financial statement analysis. These are going to be the tools that we use to analyze the financial statements. We'll go through them quickly and then give a little bit of detail on them, and then we'll give more detail in terms of how to calculate these items in future presentations. So we have the horizontal analysis, the vertical analysis, and the ratio analysis. Now there is some overlap here because obviously when we think about a horizontal and vertical analysis, we are using calculations such as ratios within that analysis, but we can break these things out into these three categories in general. The horizontal analysis is going to be a comparison typically from period to period. So we have 1 year versus another year. We're typically doing some type of analysis from period to period. That's going to be the horizontal type of analysis. A vertical analysis is a comparison within the same period. So we're comparing to a key component, a key numbered. For example, on the income statement, we'll compare everything to the goal of the income statement, the revenue generation, and we'll create a vertical analysis. The ratio analysis is us picking up key components within the financial statements using ratio analysis in order to help us get insight into the performance of the company or how the company is standing at that point in time. Standards for comparison. Note that as we go through these ratios, as we go through this analysis, we need to have some kind of standard. What's the benchmark? What are we comparing these ratios to so that we can get some insight in telling us what these ratios can give us for information into the future. We have the intercompany type of comparison. That's going to be a comparison with our own performance. For example, we might be comparing the prior year to the current year and looking at our intercompany performance. Then, of course, we have the competitors. So we might be benchmarking to our primary competitors, and ratio type of analysis really makes it much easier for us to do this type of comparison. And that's one of the major goals that we're going to have with some of the calculations that we have here. If we just look at the dollar amount, we can't really compare as easily to the competition. If we have ratios, we can, especially if the competition or who we want to benchmark to has more or less in terms of total revenue, but are in a related field, and therefore the ratios will be much the same. So we want to be able to compare to the competitors with this type of analysis. Industry standards, another goal we might look at the standards in the industry as a whole and basically, once again, take our ratio analysis and be able to compare it on a ratio basis to the industry standard in a way that we could not so do with just a dollar amount standard oftentimes. We can also be comparing to guidelines, certain guidelines, and making sure with the ratio analysis to see if we are within those guidelines. Here's an example of horizontal analysis. We'll go into more detail about calculating the horizontal analysis, but just to get an idea, we'll typically have the current year, we'll have the prior year, and then we'll have the change from the current year to the prior year. And then we're going to take the percentage change. And this is where we get to the ratio, and the percentages are often going to be something that's going to help us to do some comparisons that we can't do as easily when we're looking at just the dollar amounts. For example, we might try to set a standard and say if there's a significant change over a certain percentage, even though the dollar change is going to be different for each account type, we could set some type of standard, say, hey, I'm going to take a look at everything over basically a 15% difference in terms of the percent change or something like that as a general rule. And this is going to be comparing, of course, 1 year to the prior year. So we're comparing periods in this case, typically of the same company when we're comparing horizontal analysis. Also note that you can say that this is a form of ratio analysis in some case because we are taking kind of a ratio, the change that is happening here compared to the prior year. That's going to be a type of ratio that we are using, but we're considering this in terms of the way it's formed out, going through the whole financial statement as a horizontal type analysis because we're basically comparing one period to another period. So it's going to be a horizontal type of analysis, but of course within that horizontal type of analysis of the financial statements, we will be using ratios to break that out into the percentage change. Here's the same thing for the income statement. So we have a horizontal analysis for the income statement. Current year, prior year, we have the change in that, and then we're taking the percentage change. So we're taking the change from 1 year to the prior year, horizontal analysis, same company over time. We can then take a look at these percentage changes and consider, especially on the income statement, now we have a performance document, what a timing statement, how are we doing type of statement over a certain time period, and we can go through these percentages and consider once again the large percentages, possibly set a standard of a percentage over a certain standard we're going to look into and analyze and try to get some insights into why there's such a different percentage change. We can compare the horizontal analysis to the vertical analysis. When we consider the vertical analysis, we're typically comparing to the same period. So we're comparing different line items on the same period. You could think of it as taking the biggest line item or the most important line item on, say, the balance sheet in this case, and comparing every other line to it. So in the current year, if we took the 20,000 and compared it to the total assets, the 375, we are comparing everything in that format. So the 20,289 in cash divided by 375,319 gives us the 5.4% if we move the decimal over, and that's going to be our percentage. So we can consider that then kind of like a pie chart. You can imagine a pie chart type of analysis where you're saying, well, this is 5% or so, 5.4% of the total assets. We have the short-term investments, 14.4% of the total assets. Liability, and then we did that for the current year and the prior year. So we're not doing a year over year horizontal, we're doing each of these vertically in this case. A comparison only in this column relates to this column, and then of course this column relates to this column. We're not doing a horizontal but a vertical type of analysis. We could do the same thing for the income statement, where we would compare everything to, in this case, the most important number being net sales, the sales number, the generation of revenue. So we would compare, for example, the cost of goods sold here would be 141,048 cost of goods sold over the sales line, which is 229,234, and that's going to give us the 61.5%. 61.5%, and we're going to compare everything on this line to the sales and get an idea of the percentage as compares to the goal being the generation of revenue. Once again, this column only comparing to this column. We're not doing a horizontal but vertical analysis. This column for the prior year is going to be related to this column. Then we have the ratio analysis. When we consider the ratio analysis, we break those out typically into 4 categories. So we're going to have the liquidity and efficiency, we have solvency, we have market prospects. So when we consider these categories, we want to be able to understand these categories and break out the ratios within these categories. We want to understand that we have the vertical analysis, we have the horizontal analysis, then we have the ratios, and typically we want to break these information out into these categories for the ratio so we have an objective and know what the ratio is there for. And that's going to be a very common type of test question as well. So they might just ask you, here's the ratio and what category is it there for? What's the goal of the ratio in terms of the categorization? In practice, of course, we want to have an idea of what the ratio is doing. And as we think about the ratios more and more, that's really the only way to kind of think about this. You want to just keep doing the ratios and then thinking about what the ratio is telling you and then analyze why the ratios would change. And as you do that more and more, you get a better idea of what that ratio is doing, what it is telling you. The liquidity ratios, we'll go over all these ratios again as we calculate these ratios, but the liquidity ratios include the current ratio, the acid test ratio, the accounts receivable turnover ratio, the total asset turnover ratio, the inventory turnover, the days sales uncollected, and the days sales in inventory. Note that the liquidity and efficiency are going to be the most common types of ratios. So if you got a question, you're saying, I don't know which category to put this ratio in, well, then your best bet is probably the liquidity is, in terms of statistics, the liquidity and efficiency ratio, if you have no idea. And then we have the solvency ratios, when that's going to be the debt ratio, the equity ratio, the debt to equity ratio, and the times interest earned. Profitability ratios include the profit margin, the return on total assets, the return on common stockholders' equity, and then the market prospects, which include the price earnings ratio and the dividend yield. In this presentation, we will discuss and take a look at an example of horizontal analysis. When considering horizontal analysis, we're considering performance over time. So we're comparing period over period of the same company typically. So that would be year over year. We could have 2 years. We could have multiple years. We're going to be comparing 2 years here in the horizontal type of analysis. We're going to do this for the financial statements, including the income statement and the balance sheet. So here's going to be the income statement. We have the comparative income statement, meaning we have the current year and the prior year. Note that oftentimes we'll see the current year first when we consider the lined up income statements or financial statements side by side. And that might be counterintuitive to many of us who would think, well, I would think it would read from old to new, right? We're reading the old point in time, last year to current year. But no, we're a bit impatient oftentimes in the accounting and financial statement world, or readers of the financial statement. They want to see the most current stuff, which we would assume is the most important stuff first. So most of the time we'll have the current year first, and then we'll have the prior year after that. That's going to be a typical type of convention. So then we're going to do a comparison year over year, and that would of course make sense. We'll say, well, how did we do last year compared to this year? Well, let's line them up line by line in terms of the income statement, the performance statement. And remember, when we're considering the income statement, we're considering performance. How did we do over a time period as opposed to the balance sheet, which is considering a point in time. So we're going to say, this is what we did last year. This is what we did this year. Let's just take a difference between the two. We'll create another column, just subtracting those two out. So of course, each line of these are just basically subtracting out We've got the current year minus the prior year. So the current year 229, 234 minus the prior year 215, 639. That's going to give us the 13,595. We're going to do that all the way down. So the net sales had a change, 13,595 increase. That's good. So we could look at that and say, that's pretty good. And then the cost of goods sold, it went up as well. It's an expense, so that's bad. But of course, we would expect that to be the case given the fact that the cost of goods sold is usually pretty much related to the net sales, it being what we're typically selling or the cost of the things we're selling. The gross margin went up as well. That's good. Research and development is an expense. It went up. That's kind of bad. We would think that's, why did we spend more on research and development? We can look into that. We have the selling and general admin, also expense. It went up. And the operating income went up. The other income went up. So from a dollar perspective, we can go through this change and we can glean some information. We can say this is useful. We can see why we would do this. This would make perfect sense. If we're trying to think of the financial statements, how are we doing year over year? What's the trend look like? We would simply do a year over year comparison, line them up, take the difference between the two, typical horizontal type of analysis. However, we might want to break this out to a percentage basis as well, and that will give us some more insights oftentimes. So we want to see the percentage change oftentimes. And that's going to say, okay, how do we calculate the percentage change? We'll say, we'll take the change column, which is 13,595, and divide it by the prior year, not the current year, the prior year. That's the tricky kind of thing. That's the thing that ties people up. People often forget is that we're going to divide it by the prior year. So we're going to take the change that happened, divide it by the prior year, 215, 639. That's going to give us, if we move the decimal over, the 6.3%. And this is applicable not just to financial statement type of analysis, but any type of thing where we're basically trying to see how did we do year over year. Like batting average, it happens in sports, oftentimes happens in performance in terms of job performance in many cases. We're trying to say, how did we do year over year? Well, let's take the dollar change and then we'll take a percentage change. And the percentage change can be really useful to us because we can compare this percentage change to other industries possibly and look at their percentage change, even though they don't have the same amount of dollars that we have. And we can also take this percentage change and we can apply general type of rules for types of analysis rules that we can go through and look into. For example, we could set a rule that says, hey, I'm going to look into any type of percentage change that is over a certain percentage change. So we could say 10%, anything over 10%, we're going to look into, we're going to analyze, we're going to write down, we're going to take notes, we're going to see why that change happened. We're going to dig into it more. Cannot do that so easily with a dollar change. You could set just a dollar change and say, I'm going to look at everything over this dollar change. But note that different accounts, of course, have different dollar amounts. And therefore, when we set just a dollar type amount, it could be significant compared to one account, but not another. It might be useful oftentimes to look at a percentage change and then think about the significance of a percentage change. Both have their pros and cons. Also, if we were to compare it to other companies, then if we're thinking, how did another company do year over year? And if they're a lot larger than us, if we're, for example, a small hamburger shop and we're comparing ourselves to McDonald's and we want to glean some information from McDonald's, get some insights from what they're doing, then we can't really take a look at our dollar amounts here because they're not going to make any sense as we look at the dollar amount change for something like McDonald's. But we can look at McDonald's year over year horizontal analysis and say, oh, did their sales go up, 6.3%? Did their cost of goods sold go up 7.4% in relation to that as well? What's their gross margin percentage increase? And we could take a look at those percentage increases and consider whether or not we're in alignment in some ways. And again, this is very useful for things like batting averages and stuff, any kind of performance that we're trying to measure, any job performance. That's basically what statistics are for baseball. We're measuring their job performance. How are they doing? Well, we have to consider how they did last year compared to this year. Are they improving? Are they improving in comparison to other players? Well, other players had more at-bats or less at-bats. How can we basically account for that? Well, we could start to look at percentages, and that's one way that we're going to look at these things. So very useful for many different areas. So we could go through this and then say, okay, anything over 10%, let's say, we're going to figure out and then look into further. So the sales, we'd say it's a 6.3. So that's not a big change. Cost of goods sold went up a little bit higher than the sales, so that might be a little concerning. Why would the sales go up by 6% and the cost of goods sold went up by more? You would think they would be going up at about the same rate. And then the gross margin, of course, is a function of those two changes. The research and development went up by 15.3%. That's fairly high. We could go into this and dig into that and say, hey, well, are we doing more research and development? Is it paying off? What's the long-term objective on the research and development? Why is that going up? Selling and admin, it's fairly in the range. Total operating expenses, of course, is a function of these two, mainly the research and development going up. And then we have the operating income and we have the other income, which went up significantly. So we'd want to take a look at that. Why did that go up significantly? Also note that these ratios have limitations as well, because it's possible that, for example, if this goes up significantly, but it's a small dollar amount in total in comparison to everything else. So for example, if this was like $1 in the prior year, and then it went up to $20 in the current year, we'd have a significant percentage change. But from a perspective of total dollar amount, it wouldn't be significant really in terms of, is there going to be a significant impact or effect on the financial statements? So we have to use both of these basic methods and use just logic and say, let's look at all the data that we have here and think about what's the best picture we can come up with, and then create a plan to figure out how to analyze the financial statements. So then we have the income before taxes, the income taxes, and the net income. We can, of course, do this as well for the balance sheet. Remember, as we think about the balance sheet, we're thinking about as a point in time. So we're trying to basically look at a comparison of where we stood in a prior period, where did we stand last year in this case, and where do we stand this year, as opposed to how did we do in performance, like a stopwatch, like the income statement. What did we do? How much did we earn? How much did the stopwatch go up? In this case, we're saying what is our end position at the end of this year compared to the end of last year. Same kind of routine though. We'll do a comparison between the two. So we'll take last year, here's the cash we had this year, and here's the cash we had last year, and it went down by 195. And so we go to the short-term investments, it went up, and we go to the accounts receivable, and these two of course might be related. We say, why did cash go down? Maybe we put more money into the investments, and then we have the accounts receivable, it went up. We've got the inventory went up, other receivables went up. So you can see that this would be a common type of analysis we would do. Obviously, we're going to say, well, here's last year, here's this year. Let's line them up and subtract the two, see what the difference is. Where do we stand as of last year? Where do we stand as of this year? What's the dollar change? Then, of course, we can take the percentage change in the same fashion, giving us that same kind of information that could be useful for us. And then we can basically look at that percentage change and say, are there any of these percentages that might stand out? Like obviously this one stands out, inventory stands out to us and says, that's a pretty big percentage change. Might not have noticed that change as much or focused in on it if I just looked at the dollar change. And so it's going to give us another look, another feel for this information that we can then use to go back through. So obviously the cash change fairly small. Short-term investments, 15% increase. We might go in there and say, why did we put more into investments? Accounts receivable, 13, somewhat significant. We can look into the receivables and say, are we collecting on the receivables? Why are the receivables going up? Do we have uncollectible receivables on the books or something like that? Inventories has a significant increase, and we could think about that in terms of a percentage basis, although the dollar amount might not be that significant. So we might look into that and say, are we holding on to inventory too much? I mean, are we overvaluing inventory? Should we be holding on to less inventory at any given time? It might be more efficient. Other current assets, we have a large increase, so we probably want to look into other current assets, break them out and say, let's log that out, let's break them out and look into them. Then we've got the long-term market securities also went up, so we're investing overall more in securities. Property, plant, and equipment. Did we buy more property, plant, and equipment? We basically want to put that in place. There's a significant increase, so I would assume there was a purchase. Is that purchase doing well? So we might want to just be able to justify that. Intangible assets went down, and so we might want to look into, how did the intangible assets go down? Something like goodwill or patents or something like that. and then non-current assets. So we can look into each of these individually, depending on which ones have the significant changes. And then we can consider the liabilities, of course. Now we're just going to the liability side. Same thing, we'll have the difference in the liabilities. And then we'll take the percentage change. So remember, the percentage change is simply going to be the difference in dollar amount, 11,755, over the prior year, which is the 37,294 in our example, to give the 31.5%. Here's the 31.5%. And again, we can go through each of these and look at the significant changes. Obviously, we would do this. If you were to compare financial statements, this would come to mind pretty soon. We'd say, let's compare last year to this year and let's subtract them and see the difference. And then we'd say, well, maybe the percentage might give me more insight. And so we would do the percentage here, say, there's a 31% increase in accounts payable. Why? I mean, are we not paying our accounts payable as fast, or what's going on there? Accrued expenses went up, deferred revenue, other current liabilities, significant increase. We might want to go into that and take a look at it and write down, log down what happened, see if it's significant or if we need to make any changes. Current portion of long-term debt. Did we take out more debt? Did we take out another loan? It seems to have increased. And then we have the long-term debt also went up, the long-term portion. So again, did we take out a loan? Looks like we did. And then we have the other non-current liabilities, 12% common stock. So did we sell stock possibly here? And so we can go through these percentages and they can give us some more insights into the analysis of the financial statements. And again, if you're thinking that the dollar change, you might think the dollar change is enough. I just need to know the dollar change. But honestly, if you any type of measurement tool that you're going to have when you're comparing different things, especially things of different sizes, the ratios are what you're really going to need, and they can give you a lot more insight to compare different types of things. And that's what you want to get used to, are these types of ratios. And once you do, they're not too bad. So here's just a look at the whole balance sheet. So here's the asset side, and here's the liability side. Here's the current period, the prior period, current period, prior period, the dollar change, and the percentage change. Note that trend analysis is also a form of horizontal analysis. In a trend analysis, what we're going to do is compare everything to a base year. So in a trend analysis, we're comparing period over period again, but maybe possibly more than 2 periods, and therefore we're going to be comparing to the base year. When we only have 2 years, we can consider the current year or the prior year the base year as well, because we're doing a comparison to the prior year. But if we have multiple years, we have a type of trend analysis, and we're going to consider what the base year is. For example, here we're going to say this is the first year, this is going to be the base year. We're going to compare everything back to the base year. So when we do the comparison on year 2 and we come up with our percentages, we're comparing to 2001, and then in 2000x3, we're not comparing to 2000x2, but back to 2000x1. 2000x4 comparing back to 2000x1, and that gives us everything based on the same base year to give us our trend analysis. We'll talk more about trend analysis in a future presentation. In this presentation, we will take a look at and work an example problem related to trend analysis, a type of horizontal analysis where we're going to be comparing multiple periods, typically multiple years, and we're going to be comparing them to a base year. This is the data that we'll be using. We have the income statement up top, we have the balance sheet down below, and we've got multiple years, 2000x1 to 2000x7. Note that we have the most current year first, and that's going to be a common type of convention. It might be backwards. You might be thinking, hey, why don't we have the base year first and read left to right as we would a story starting from the beginning, going to the end of it. But again, most of the time the analysis of financial statements are going to be a bit impatient, and they want to have the most relevant information, typically the most current information, first. And so we'll keep with that convention, typically have the latest year first. So 2000x7 first, back to 2000x1. And we're just going to be comparing this information, of course. So on the sales, cost of goods sold, gross profit, operating expenses, we've lined everything up so that we have the same numbers in the same line items for each of these years. Note that if you're doing this in practice, of course, you'll have, if other accounts were added, say there's multiple expense accounts in one year versus the other year, well, then you're going to have to adjust for that, put a 0 in the year that doesn't have any expense account, and obviously the data in the account that does, and basically line up the accounts here and make sure that all the years line up as we do this comparison in a side-by-side fashion. Once we have this information, we can then do our analysis with it in a fairly quick fashion. What we're going to do here is consider the first year as the base year, and then we're going to consider everything else as it compares or going back to this base year. That's going to be a little bit different than a typical year-by-year horizontal analysis where you might think of just 2 years at a time. In other words, if we just had 2000x1 and 2000x2, we would typically think of 2000x1 as the base year compared to 2000x2, and we would do a horizontal analysis. However, when we start going out to 2000x3, and so in that case it would be pretty much the same under the trend analysis and the standard horizontal analysis. If we go out to 2000x3, however, then we're comparing 2000x3 number not to 2000x2, but going back to the base year. And what that does is it gives us a nice smooth trend, all being based on the same base year when we consider the percentage changes. So we'll consider the percentage changes not based on the prior year each time, but based on the base year. So when we start to construct our trend analysis, what we want to see are percentage changes based on the base year every year, then going back to the 2000x1 or the 755. So if we were to consider this just for sales, then let's do this for sales. 755 over 755, the base year is always going to be 1 or 100%. Then if we go to year 2 in our trend, we're going to say the 921 divided by the 755, there's a 1.21 increase. So it's going to be increased 1.21, or in other words, 2000x2 is 1.21 or 22% of 2000x1. And then if we go to year 3, we've got the 991 divided by the 755, and now we have a 2.31 increase. And then we go to year 4, and the key is we're just always going back to 2000x1. So 10362 divided by the 755, that's going to give us a 1.4. And then we go to 2000x5, and we take the 1158 divided by the year 2000x1, 755, and then we got the 1.5, and so on. So if we consider this in terms of the creation of our income statement in this format, we'd have the sales in a percentage basis. So here's 2000x1 base year, 100%, because it's going to be itself divided by itself. 2000x2 compared to the base year is an increase of 22% increase. So we see the trend upwards in this case. That's a good trend for us. If we see 2000x3, it's not being compared to 2000x2 numbers. 2000x3 as compared to the base year 2000x1 means there's a 131.3 increase. And you can see by doing this, we see a nice trend based on the same base year. And so we see a trend upward based on the 2000x1 base. Now you might ask, well, how do we choose the base year? It's going to be an arbitrary type choice based on the information we choose. But it's useful to us because it gives us that base of comparison. All we're looking for is a standing point, is a flag, is a comparison point for us to then see a trend based on. So we need some static base period so that we can see the trend analysis in relation to it. So obviously 2000x4 is compared to 2000x1, and we can see that nice trend upward as well. 2000x5, 2000x6, and 2000x7. We can also graph this information. Note if you see the graph down here for the sales, we've got the blue line for the sales. So this is going to be our graph. Notice it's going backwards. You might consider the graph, you'd like to read it from left to right, but we created this graph with this table that's in reverse format. So in order to create the graph the other way, we would have to reverse the table. So in any case, we see the trend then going from 2000x1, and it's increasing in this format as we go to 2000x7. And so that's going to be a good trend for the sales. And then we just do the same thing all the way down, same type of analysis. So for 2000x2, obviously we have 556 divided by the 443 for 2000x2, that's 1.2. If we go all the way out to 2000x7, we're going to have the 1045 divided by the base year of the 443. That's going to be the 2.39. If we go back to 2000x6, 850 over the 443, that's going to be the 1.91. And we do that all the way through. And again, we're comparing to that same base year. So if we go to the cost of goods sold, then this is what we have. The 100% always going to be on the base year, of course. 2000x2 as compared to 2000x1, we have the increase 125.5. 2000x3 as compared to 2000x1, 134.3. 2000x4 as compared to 2000x1, 144, and so on. And we could see this type of increase. We can, of course, do the same thing for the gross profit, which would be the 408 in 2000x7 over the gross profit of the 312, and that would be the 1.3. So we'd have the 1.3 here in the gross profit. So there's going to be the 130% on the gross profit. We can also see this information on the graph. So you'll note that the sales, we looked at the sales line here, but the cost of goods sold line is going to be this item. It's going up at a faster rate than the sales line. And then we have the gross profit line being the gray line here, which is dipping down as a result of that. The sales going up, good. The cost of goods sold going up at a higher rate, bad. And therefore the gross profit is starting to dip down here. And we can do this again for the operating expenses, same type of analysis. We're going to be comparing everything to the base year. And then we have the net income, once again comparing everything to the base year. This is giving us a nice type of trend. That's what we're looking for. We're looking for a trend. We want to make that trend be based on something that is solid, some solid foundation, and one that doesn't change. And all we need to do is basically choose that foundation, in essence, arbitrarily, so that we can then compare something to it and then see a trend based on that one point, based on that point in time. So then we're going to have the same information now looking at the balance sheet. We can do the same type of analysis with the balance sheet. And of course, we're going to do the same type of calculations on the balance sheet side, some type of horizontal type of analysis. So we'll take the cash, for example, 2000x2, 176, divided by the base year, 181. That's going to be the 0.96. And then we're going to do the same thing for the 2000x3, 178, divided by the base year, 182. That's going to be the 0.97. And then we can continue on to 2000x4, 172, divided by 182. That's going to be the 0.94. And then we can go to 2000x5, 168, divided by 182. And that's going to be the 0.92. And again, we're basically comparing everything to 2000x1. As we do this, remember that when we look at the income statement, we're looking for performance. So we would expect to see a nice trend upwards because it's performance. That's what we would hope for. That's what we want to happen because we want to be able to increase our performance as we go. Balance sheet, we're thinking about a point in time. So we're not necessarily thinking about there's going to be a constant increase in say cash. I wouldn't expect cash to just be increasing all the time. That wouldn't make any sense. That we don't want cash to increase all the time. If we had too much cash, we want to spend it in order to help us to generate revenue, or we want to give it to the owners in terms of dividends in some format. So we wouldn't have the same type of expectations as we do this type of trend analysis, but the trend analysis can give us perspective. So remember, when we see the trend analysis with regard to the income statement, we're hoping to see a nice even upward kind of trend, and we're looking for any kind of non-even upward trend and trying to consider what happened in that region, that area. When we look at the balance sheet, we're not really looking for the same kind of trends per se. We're taking this on an account by account basis and trying to consider what significant changes are happening, and then we can explain to ourselves, well, why are these changes happening? If cash spikes up at a certain point in time, why is that the case? Did we earn a lot of money, or did we take a loan out, and are we using that in the way that we should be using it? Those type of questions. So if we then consider the assets, then same comparison to the base year, 2000x2 actually lower than the base year, 2000x3, 2000x4 lower than the base, and we can see the trend all once again compared to the base year, not compared to the prior year to it. Accounts receivable, here's the base year. We're comparing everything to the base year. So there's an increase in accounts receivable. Note again, as we see this increase in accounts receivable, you might say, well, that's good. We got more people owe us more money over time. But it might not necessarily be the case. It might be the case that we're not collecting on our receivables as we should, or something like that. So this trend, as we see it increasing, the increase in the trend, even though it's an asset, doesn't necessarily mean it's going to be a good thing, but it is an indication for us that we can go into it and say, well, what is going on with this? Then we got the inventory, 100% in 2000x1 increasing. And again, the fact that inventory is increasing isn't necessarily a good trend. I mean, are we holding on to more inventory? Are we buying inventory and then just holding on to it? Because we should be selling this stuff. It's going to get old after a while. So we don't want to spend all our time holding on to too much inventory. So no, even though it's an asset and you would think, well, it's going up, that's good. It's not necessarily good, because the only reason we're having assets is to help us generate revenue. Otherwise, we should sell the assets and give the money to the owners, right? In terms of dividends. And then we've got the other assets comparing to the base year. And then we have the long-term investment. So we obviously see that they went down to zero at some point in time. So we sold the investments. We could say, okay, why did we sell, what did we sell the investments for? Did we use the money properly? Where did the money go? We've got the plant assets, again, starting at the base year, everything being compared to the base year. We have an increase in the plant assets. That would mean that we purchased more plant assets. Possibly we sold the long-term investments, maybe, to buy more plant assets. That could be a good thing, could be a bad thing. Are we using the plant assets effectively in order to help us to generate revenue? If we are, good move. If not, possibly not. We've got the total assets here then. So we're summing, we've got the total as compared to the base year. So total assets are increasing. Again, we could think of the total assets increasing. You say, well, that's good. We've got more assets. We want more stuff. We want more stuff. But once again, just remember that the goal of the company isn't just to own stuff. It's to generate revenue. If we have a lot of stuff that we're not using that we own, we should just give it to the owner so that they can spend it in terms of dividends in some way. So the fact that the assets are going up is good, could be considered good, but not necessarily totally good. The question is why it's going up, and are we using the assets that we have efficiently? And then we have the liabilities and equity. So on the equity side, same thing, and the liability side here, current liabilities, we have an increase in current liabilities. So these are going up, and you can consider that generally is not good. So why is there an increase in the current liabilities as compared to the base year? That seems to be going up steadily, and possibly we're ramping up more stuff. Maybe we took out a loan possibly to pay for the property, plant, and equipment in order to generate revenue. So that could be a good move, could be bad. We have to, but consider that information. Long-term liabilities, also an increase. So once again, as compared to the base year, we would say, well, looks like we took out a loan possibly in some case, possibly to buy more property, plant, and equipment. The common stock is increasing, so possibly we financed something with the sale of common stock. Paid in capital increase, as we would expect with the increase in common stock. And the retained earnings, we see the increase as compared to the base year in total liabilities and equity. So you can see this is just going to be a common type of extension of the horizontal type of analysis. We're comparing one year compared to the other year, and then we're saying, why don't we do a percentage comparison? That would make sense. And then you could think how you would start saying, well, I want to compare over multiple years and see how we've done over the last 5 or 10 years or something like that. How can we do that in a horizontal type of analysis from a percentage basis? Well, let's pick a base year. We have to pick a base year and then compare everything to that base year, and that's how we would get to this. So these ratio analysis are really pretty intuitive if you start to think about them for a while. You can just think about how you would create something if you were to make this from scratch. No one knows anything about it. You're saying, how am I going to start to think about how we're doing? Well, let's compare this year to last year. Well, let's compare this number to that number. And now let's compare everything to a base year. And you can see how this stuff would be constructed and formatted just to try to get some more insight, another angle on it. Usually the tools to do that is some type of ratio, some type of fairly simple ratio. In this presentation, we will take a look at and work a problem related to vertical analysis, sometimes called common size statements. When we think about the vertical analysis, we will be considering the analysis of the same period as opposed to horizontal analysis, where we're typically comparing period to period, one period compared to another, 1 year compared to the next year. In terms of a vertical analysis, we're comparing 1 year to itself. Here is our data. We have an income statement. We're going to start off with the income statement. We have a comparative income statement. We have the current period and the prior period. We're going to be doing a vertical analysis for each of these periods. Note that as you think through these ratio analysis, what we want to do is kind of think from scratch. What would we do if we just want to get some more information about our data and we're just trying to put together some formats to do that? The horizontal analysis is more of a straightforward type of thought for most people, I would think. In other words, the horizontal analysis that we looked at in prior presentations would be the idea that, well, why don't we take the 2 years of data, let's line them up line by line so they line up side by side with the same accounts in the current period and the prior period, take the difference between the two, then we could see the change, what happened year over year with regards to performance, and then possibly take the percentage change. And that would be one of the more intuitive ways to me to look at the data. We'd probably figure that out, come up with that type of analysis. The vertical analysis is a little bit less intuitive, but it makes perfect sense once we start to think through it. What we're going to do is be able to compare each line to itself, and we're going to be comparing it to basically the most important line item on the statement. In this case being the income statement, we're going to compare everything to net income. In other words, note that everything on the income statement, everything basically in the business from an accounting standpoint is there in order to help to generate revenue. So what we want to do is think about every line item as it's compared to the revenue account, the sales account in this case. And also note that if we take the sales account and we subtract all the expenses, obviously the basic accounting equation on the income statement is revenue minus expenses is net income. So what we're going to do is take basically all the expenses as they relate to revenue, and that's going to be the comparison that we're going to be making. And of course, if we add up then all the expenses and net income, it should add up to 100%. It should add up to the sales number. In other words, the basic equation is the 229,234 minus all the expenses. So if we were to add up all the expenses and net income, it should add up to the total of 229,234. So that's going to be, in our case, the 141,048. I'm not going to add up the total, the subtotal. We're going to go to research and development, 11581 plus the selling and admin, 15261 plus, this is a subtotal. I'm not going to add this. Subtotal, I'm not going to add this. Other income, I'm going to actually subtract that because that's income rather than an expense. We're adding up the expenses, 27545 plus the taxes. I'm not adding the subtotal and the taxes, 15738. So that's going to be all the expenses, and the income minus the expenses is net income. So I have to add net income, 48351, and that's going to give us our 229,234. And therefore, if we take each of these line items, then we're basically taking a percentage of a total. So the total pie is, of course, 100% represented by the 229,234, and we're going to look at all the categories and compare them to that total. So it's a little bit backwards than we might normally see the total, which we would think is on the bottom of a lot of type of calculations when we think of like a pie chart type of analysis. In this case, on the income statement, of course, we're comparing everything back to the main number, the number that we're most concerned with, the number that we're looking to achieve, what all the expenses are there for. That's going to be the sales number. So keeping that in mind, we'll record this as also called a common size statement, and that's going to be because we can compare it to other types of financial statements. So note that as we see this in terms of dollar amount, we cannot easily compare it to other types of businesses. If I want to compare, for example, our little hamburger shop to McDonald's, can't do it because McDonald's revenue will be way too high, and we can't compare those two things. They're not the same thing to the same thing, or apples to apples, as they say. We need to make them a common size statement, and this is the way to do that. We can do a percentage statement, represent everything as it's related to sales number, and then we could do the same thing for McDonald's, and we could basically compare the two then in a much easier fashion and get some more information that we never could do if we were to keep everything as such a dollar amount. So the common size numbers then for the current year, this relating to this column, are here. Now if we go through these calculations, they're just going to be comparing everything to the sales line. So obviously this 100% is simply the 229,234 divided by 229,234. That's 1 or 100%. And we're not comparing anything to the prior year. We'll do that next. We're just doing a vertical analysis on the current year. So the next line item is obviously the 141,048 divided by the sales, 229,234. Oh, something happened there. Let's do that one more time. The 141,048 divided by the 229,234, and that's going to give us the 61.5%. Obviously, that's going to be the highest percentage when we look at a vertical analysis. Typically, it's for a company that sells inventory, because the inventory is going to be the highest dollar amount of the highest expense with relation to the sales. And then we have the gross margin, which is going to be the 881836 divided by the 229,234. That gives us the 38.5%, which could also be calculated as 100 minus the 61.5, 38.5%. So you can do those subtotals either way, and you can basically double check your work in that format. You can just go all the way down through this 11,581 divided by the 229,234. That's going to give us the 0.5 or 5.1%. And we can keep going through this, the 15261 over the 229,234. And that's going to give us the 6.7%, and so on and so forth. This gives us a relation of every number to the, basically in essence, kind of the total, or to the most important number, the sales number. And remember, income statement is a performance account. How are we doing over time? This is kind of like the stopwatch account. Here's we're starting and we're ending. It's measuring something over a time period, as opposed to the balance sheet, which is only measuring as a point in time. So as we do this, what we're thinking about on all these expenses is really, these are the things that we had to expend in order to generate the revenue, which is the goal. So this is the goal. This is what we're trying to do. This is what we had to expend in order to do that. Then we can go through here and we can see what our highest expenditures were. And obviously cost of goods sold will be the highest expenditure. And then we can go through and see the rest of the expenditures. Now note, we can then take this common size statement and compare it to other companies which have much different total dollar amounts, but have similar ratios in terms of a vertical analysis. That's going to be one of the key components. Now, if we did it for the prior year, we could do the same thing. Remember that this is only being calculated based on the prior year. So if we were to do these calculations, we're just going to take the sales number by itself, is obviously 100%. And then we could pick up the cost of goods sold, same concept. We've got the 3,131,376 divided by the 215,639, and that's going to give us our 60%. And now we can do a comparison in a vertical analysis from a year to year. We could take a look at these two numbers and start to say, we had a bit of a change in the cost of goods sold, bit of a change in the gross margin, but from a percentage basis, we're pretty close in terms of the relationships from a percentage basis. And so we can compare those percentages on a common size statement from a year over year and or to multiple or to other different companies. If we were to graph this as well, you can kind of consider this or think about this in terms of a graph, and it might look something like this. And you can then give a pie chart and give a visual and say, look, here's basically our expenses. These are going to be the largest expenses being the cost of goods sold, and then you can break out the expenses from there. This could be a nice way to give a visual of what it is that that we're expending in relation to the gross sales number. And of course, we can do the same thing for the balance sheet now. So we're going to look at the balance sheet. We're first just going to look at the assets. So we have the same kind of setup. We have a comparative balance sheet. We have the current year and the prior year, and we're looking at the assets. What we want to do then is consider everything in this case to the most important number, or to the total number. In other words, all these assets line up or add up to total assets. This is going to be the total. We're going to compare everything to it. Now, as we go through this for a company, you can also think of how you might do this personally. This is going to be very applicable to something like your investments or something like that, or any type of asset category that you have, because you could do the same type of thing and compare everything to your totals. And by doing so, you could start to compare what your grouping is in terms of where you're investing what you have in, as compared to possibly someone else. And this is common in like portfolios or things like that. How much is invested in stocks, how much is invested in bonds and whatnot. And you can compare it to someone else. Well, those same principles apply here, but obviously by industry, because all of these assets that we have, the only reason we have them is to help us generate revenue, to help us grow the business. So we want to be able to take these and compare them on a percentage basis, possibly to other types of businesses in our same industry, and consider not from a dollar perspective, but a percentage perspective, how much do we have in each grouping. So if we went through that, we can say, all right, the current year, this is a common size statement, is going to be the comparison everything to the total now. And this kind of makes more sense or easy to calculate, because the total, unlike on the income statement, is on the bottom where you would expect it to be, as opposed to on the income statement where we're compared everything to the total, which is basically the sales number, the way we're setting that up. So in this case, we have the 20,289 divided by the total down here, which is the 375,319. That's going to give us the 5.4%. So that means that of this total of assets, of all the assets that we have 5% in cash. Now, remember what we can do with that is we can look at other companies that are in the similar industry. Like, again, if we're comparing our little hamburger shop to McDonald's, we could say, well, it doesn't help me to compare how much cash we have compared to them. That's ridiculous. But we could compare the percentage cash that they have as compared to their total assets and consider that. And you can consider this in a stock portfolio type of thing, or stocks versus bonds or investments. We could say, obviously Warren Buffett has, or, some famous investor has a lot more money than we do. How can we get information from what they're doing? We can't do it from a dollar amount standpoint, but we might look at their whole portfolio and say, hey, this is how much they own in stocks, at least, versus other things, and possibly get some information from that kind of analysis. And that's a similar analysis we're doing here, but on a business standpoint. So 53,892 over the total, always comparing to the total, 375,319. So that's going to give us our 14.4. We're always going to have to deal with rounding, always. And we got 17874 divided by the total, which is 375,319. And there we have our 4.8. And then, of course, if we do this whole thing and we go down to, like, say, total current assets, 128,645 divided by the total, which is the 375,319, that gives us our 34.3%, which you can also get by, in essence, adding all these up, right? 5.4 plus 14.4 plus 4.8 plus 1.3 plus 4.7 plus 3.7, 34.3. So you can double check those subtotals, a lot easier to do within Excel. And then we can take a look at these percentages and we can say, okay, this is how much percentage-wise we have in each of our assets. In other words, if we consider this asset as the total bucket, this is the percentage that we have allocated out. And we can do that for another company as well. We can say this is the total assets they have. Maybe they have $1 million in total assets, but then we can consider the buckets that they're putting them in relation to the total, and that can give us some information. Remember that as we look at the balance sheet, our goal here is to think about where the assets are at a point in time, as opposed to the income statement. Always keep that in mind when you're doing these types of ratios. The income statement is performance, and so we would expect hopefully revenue to go up in some way, and we would hope the expenses would go down or have some kind of smooth trend. Balance sheet, we got kind of different types of perspectives. We're trying to use our assets most efficiently and leverage the liability most efficiently. So we could do the same thing for the prior year. So we could just do the same thing. Remember, we're comparing the 1 year to itself, not doing anything with the 2 years. This is the vertical, not the horizontal. And so in this case, of course, if we take some liabilities this time, we go down here, 174.3. I'm not liabilities. We go down here to the other assets, divided by the 321,686, and that's going to give us the 53% about. And then we could do that for one more, the 27,010 divided by the 321,686, and that's going to give us our 8.4. So we could do that for both of these years, and again, get some more insight on a percentage type of basis. We can also graph this, and you can imagine this graph, and this is a typical kind of thing we would do for stocks and investments for personal as well. We'd say, hey, these are your total assets. This is basically a visual of the groupings that you have those in. So obviously the largest grouping here is the non-current assets, and then you can go through and then you got short-term investments are pretty high. Then the orange is the inventories are pretty high, and you can go through here and you can get a visual of basically what the investments are, and possibly again compare these to a visual of other companies that are in similar industries possibly. You can do the same thing for the liabilities, of course. So same type of analysis. We got the current year and the prior year. We'll do the vertical analysis. We're comparing to the total, remember. So in this case, we're comparing to the total down here. As we look at the liabilities and equity, a couple things we want to remember. One, we're not going to be grouping liabilities to the total liabilities. So that's a common confusion. We're not going to be grouping the three categories, assets, liabilities, and equity. In that format, we're grouping the liabilities compared to the total liability and equity. And the reason we're kind of thinking that way is because note that the balancing concept is assets equal liabilities and equity. So it's not like we're not grouping the three out, assets, liabilities, equity, three categories, but two categories, assets, liabilities and equity. Why does that make sense? Because the liabilities and the equity represent who has claim to the assets. So remember, we're balancing here, of course, means that this 375, 319 of liabilities and equity is equal to total assets. And remember that the liabilities and equity simply represent who has claim to, who has ownership of, in essence, the assets that are included. So you can think of this as the same total assets number. We're basically looking at this time who has claim to those assets, and all the liabilities mean third parties have claim to it, and the equity means that the owner has claim to it, or it's the net value of the company. So as we go through these percentages, you just keep that in mind, that you can kind of compare this to, they're on the same level. Liabilities are all going to be compared to liabilities and equity, not to total liabilities, and equity is going to be compared to total liabilities and equity, not to total equity, and it's going to be representing who has claim on a percentage basis. So obviously, if we took the accounts payable, the 49049 divided by the total, which is the 375,319, we get the 13.3%. So we're saying that the payables here represent 13.1% of our total liabilities and equity, or our total assets. Same type of thing. Who has claim to the total assets? And then we could do the second one. We could say the 25,744 over the total, which is the 375,319, and we got the 6.9%. So 6.9% accrued expenses. And you can go down here and do the same thing for the equity. So 35,867 over the total, the 375,319. That means that 9.6% is claimed by the owners with relation to the liabilities and equity. And then you can go through that with the retained earnings and so on. So you got our percentages here on the liabilities, and you can do that for the prior period as well. So these just represent the same calculations in these numbers, and you always just want to keep in mind what these percentages represent. These represent basically, on a percentage basis, the claim to ownership. And you can compare this to other types of companies. You can say, well, how does McDonald's do compared to our little hamburger shop? Do they have 11% of their total liabilities in equity, or as representing total assets that's going to accounts payable? What's their representation of total stockholders' equity, possibly? How much is attributed to the owner's claim, or the net book value as compared to the total liabilities in equity or the total assets? So these are kind of relevant numbers that we can use and do comparisons with in a common size statement, meaning we can compare them to larger or smaller companies for benchmarking. In this presentation, we will take a look at and calculate some examples of liquidity ratios. Liquidity ratios will be the largest grouping of ratios, and therefore we're going to have a part 1 and a part 2 of liquidity ratios. This is part 1. Remember that as we think of ratios, we want to get accustomed to grouping those ratios. If you're taking a test situation, common test question is to ask what group the ratio applies to, and in practice, of course, our goal is to get better and better at what the objective of the ratio is. Grouping into categories does give us a better idea of the objective of those ratios. We're focusing here on liquidity ratios. Liquidity ratios are an important class of financial metrics used to determine a debtor's ability to pay off current debt obligations without raising external capitals. Liquidity ratios are going to be very important then to consider whether or not the company is going to be a going concern. Are they going to be able to pay off their current obligations and therefore be able to continue business? If they're not in a position to pay off their current obligations, then they could be in trouble of going into bankruptcy or having problems with relation to going concern. Going concern meaning the continuation of the business. We can also see that a common external user of the financial statement would be very concerned with liquidity ratios as well, especially lenders, because lenders would be calculating oftentimes liquidity ratios to see whether or not debts can be paid off. Generally concentrating on current debts, we're looking at current ability to pay, current obligations, or current liabilities, those that are going to be due within a year's time period. Other categories will include, and we'll take a look at these in another presentation. Remember that when we consider the ratios, there's generally far less in the other categories. The liquidity and efficiency will typically have the most included in terms of the numbers of ratios. So we have the solvency ratios, profitability ratios, and Market prospects ratios. Here's a list of the liquidity ratios, and then we'll go through some of them. We have the current ratio, we have the acid test ratio, we have the accounts receivable turnover ratio, the total asset turnover ratio, the inventory turnover ratio, the days sales uncollected, days sales in inventory. We're going to be concentrating on the current ratio, the acid test ratio, and the accounts receivable turnover. Note that the working capital is also a calculation we'll talk about here that falls into this category. However, it's not exactly a ratio. It's just going to be a subtraction type of calculation. So we'll take a look at that first. And the calculation is simply going to be the current assets minus the current liabilities. That's going to be equaling the working capital. So remember, current assets and current liabilities. The current liabilities are those that are going to be due within a year. The current assets are going to be the more liquid assets. So we're comparing then the assets that we have that are more liquid, closer to cash, and subtracting that from the liabilities, the things that are owed within a year. So the idea being that we're going to have to pay off the current liabilities, not with long-term things, not with property, plant, and equipment, but what we have within current assets. So if we subtract current assets minus the current liabilities, we get an idea as to whether we'll be able to pay off those current obligations, those that are going to be due within a year's time period. So the working capital calculation with our numbers here, we've got our data on the left. We've got A and B. We can think about these as two separate companies, two sets of data that we can then compare. We're simply looking at the balance sheet because we're going to be comparing balance sheet information. We're going to be comparing the current assets and the current liabilities. So note that this particular balance sheet doesn't have the subtotals for current assets and liabilities because we want to basically consider what current assets and liabilities are to get a better double check on them as we calculate these items. So the current assets then, if we go into our data, we're going to say which assets are current, which are not. Cash is current, accounts receivable is current, merchandise inventory is current, prepaid expenses is current, plant assets is not. So we want to be able to go through the categorization, current assets versus the long-term assets. And the idea here being, of course, we can't pay off anything, or we're not going to consume, or it's not very liquid to have property, plant, and equipment. They're very important. They help us to generate revenue, but they're not going to help us to pay off our current liabilities because we'll have to take a loan or sell them in order to do so. So what we want to do is take those things that might be helpful to generate or be consumed shortly in order to help us to generate the revenue or the capital, the cash that's going to be needed to pay off the current liabilities. So we got the 19,000 plus the 34,400 plus the 84,240 plus the 5,100. And that's going to be the 142,740. The calculation of what's current versus long-term is a common type of test question within these types of calculations. And obviously on the financial statements, they'll typically break it out into a separate subcategory. We'll often see a subcategory saying current assets, current liabilities. But in practice, we want to know what that is as well. And the way to test on that is to not give you that subcategory and then make you add it up. So 35,000 for B company, 52,400 plus 140,500 plus the 7,750 gives us the 235,650. Then we have the current liabilities, those that are due within a year's time period. Again, we typically have a subcategory in practice. In this case, we still have a subcategory. We just grouped them all into the current liabilities number. So here's going to be the current liabilities, those that are going to be due within a year's time period. This liability is going to be something that's due after that time period. So when we're considering the ability to pay off the short-term debt that's due within a year, we're not considering the long-term liability that's going to be due in a longer time period out into the longer time period, because we're considering the immediate ability to pay, the immediate kind of going concern whether or not the company will be able to meet its obligations within the next year. And that's going to be our working capital. We'll take the 142,740 minus the 61,380, 81,000, and for B, the 235,650 minus the 103, and that gives us the 135. Now, of course, B looks better here because the assets, the current assets are greater than the current liabilities by a greater dollar amount. But it's difficult for us to compare company to company with these numbers with straight dollar amounts. So typically, this working capital calculation, although useful, isn't always enough, often isn't enough. We're going to need ratio analysis to do better kind of comparisons. We need ratios to do so. So now we'll take a look at the current ratio, probably the most common type of calculation for financial calculations. And that's simply going to be the current assets divided by the current liabilities. And that you could see the logic behind this type of calculation. If we have the current assets, those are the things that are going to be converted into cash or are fairly liquid at this point in time, dividing those by the things that we're going to have to pay within a year's time period. So how many times over then can we pay the liabilities? In other words, we expect this to be greater than 1 because hopefully the current assets are greater than current liabilities. If that's the case, then if they were even, this would be 1, meaning we have enough current assets to pay exactly the current liabilities within the next time period, within the next year. We're hoping it's more than that because we want to be kind of safe that we're able to clear our current obligations that are going to be due within the years. So if this is 2, for example, that means we can pay off the current liabilities twice with the current asset value that we have on the books. Now, it doesn't mean we can pay everything off because the current assets aren't cash necessarily. It includes other stuff other than cash, but it includes our more liquid type of assets, the ones that are going to be consumed and used within the same year time period. So if we consider this calculation then with our data, we're going to take once again the current assets. So our current assets are going to be the 19, the 34,400, the 84,250, the 5,001 from the balance sheet compared to the liabilities. Looks like the same calculation now. However, of course, this time we're not subtracting the 2, but dividing them. So we're going to divide those out, and that gives us a 2.3 and the 2.3. So let's see what that looks like. It's so 142,740 divided by the 61,340, and that gives us our 2.3. Now notice these two calculations we've had so far are pretty simplified. You can plug them into a formula, write them down fairly easily. But as you do so, as we go forward, we'll see some of these ratios that aren't as easy to see, and we can't just plug the numbers into them. Like we don't have enough x's and variables to plug the numbers in because oftentimes the ratios will be including some other calculation that we're going to have to know how to do. So as we do this, you want to basically visualize not just the formula, but you want to visualize how you're going to use that formula in order to plug it into the data. So how you're going to make a table to do the calculations. And I would do so as you would basically in Excel, breaking out each calculation as much as possible. Practice just putting the table together so that you can write the table down and then just go through the calculations that you know are there. If you just know the formula and you haven't practiced basically how you're going to format that information when you write it down, then it's going to be more difficult. And you can practice visualizing how you're going to write it down in something like Excel using a grid format. You don't have to actually write down the table to visualize what it's going to be like. You need to have the vision so that you can then write it down in any format that you need to, whether it be by hand or by the table. Now note that B, we have the same number, but it looks a little different. We got the 235,650 over the 100,300, and we get the 2.3 again. Notice we're always going to have to deal with rounding, and many kind of test questions also might kind of be a little bit tricky by telling you what decimal place they want it to be rounded to. So just make sure that you're aware of the fact that there's going to be rounding issues with these items. You also want to consider when you're going to be dealing with a percentage type calculation as opposed to a non-percentage. This is a ratio not represented in a percentage. This too, of course, means that this liabilities can be paid over 2.3 times by the current assets. So this liabilities can be paid over 2.3 times. These are completely different numbers, but the ratio is much the same. So notice they're pretty even from a ratio standpoint, even though B has more assets. They also have a pretty much related, more current liabilities number. So we can pay off the assets with the liabilities 2.3 times. Of course, we don't have that much cash, right? It's all in other types of receivables. Hopefully the accounts receivable will be converted to cash within the year and therefore be able to be used. But we have hopefully we'll sell the inventory, right? So, but these other receivables may not be something that we can use right now. But hopefully there'll be something that we'll be able to use pretty soon. We can't use the property, plant, and equipment. That's the key. Now, another ratio is the asset test ratio, very similar, a little bit more restrictive now, because you'll note here, we're going to say, well, you know, I want to be more safe than this. I don't want to include things like inventory or prepaid expenses. Those aren't going to, they might not come through. I might not be able to use those to pay off the liabilities. Asset test ratio then has quick assets, a category we're going to have to understand because it's not on the financial statements. We don't break out quick assets like we do current assets. And therefore, we're going to have to know what those are so that on the financials so that we can add them up for our ratio. And we're going to compare those to the same current liabilities. So we have a more restricted numerator, same denominator. This ratio then is always going to be smaller. This is always going to be a more restricted type of ratio. So if we calculate this with our data, we're going to say, all right, what's going to be a quick asset? I don't know. There is no subcategory for quick assets. We're going to stop earlier. We're going to say it's cash, accounts receivable, and then we're going to stop at merchandise inventory. Inventory, in other words, is not included. We're going to be more safe. What if we don't sell the inventory? Then we wouldn't be able to pay off our liabilities. I don't want to include those to see if we can pay off our current obligations. So we're going to say, all right, it's just going to be the $19,000 plus the $34,400. And that's going to be the $53,400. We do the same for B, and we get the $87,400. We'll compare those to the same current liabilities. We're not going to shorten the liabilities. This is what is owed within the next time period. So we owe $61,340. It is what it is. We're going to have to pay that with cash generally. And we took the assets that are more closely related to cash, not including those that are less liquid, even within the current assets section. And then if we divide these two out, then here's the numbers we get. And same type of calculation, we got the $53,400 over the $61,340. And that's going to be the 0.9 about, again, rounding. So this means that we can't even pay off one time the current liabilities with the quick assets. May not be a huge concern because we do hope to sell some of the inventory. But just keep that in mind, obviously, that's what this means. This number will always be less than the current ratio because we're making a more stringent test for the quick assets. In other words, the numerator will be smaller, the denominator will remain the same. Next, we're going to take a look at the accounts receivable turnover. The accounts receivable turnover measures how frequently company converts its receivables to cash. So we want to think about how long does it take to get the receivable. Remember, when we make a sale, we're going to have a sale, and then the other side is going to be accounts receivable, typically if we make the sale on credit. And then we want to think about, well, how long does it take for the receivables to turn over? How long does it take for us to get paid? Accounts receivable turnover is high when accounts receivable are quickly collected, and therefore we typically want a higher accounts receivable turnover because that'll mean that we're collecting on our receivables more often. We're not hanging on to receivables, and obviously all the time we want money faster rather than later. So if we can get the collections faster, that's always going to be better, if nothing else, because of the time value of money. Calculation then is going to be net sales divided by the average accounts receivable net. Now, when we see these terms, these can be a little bit confusing. This is going to be one of the types of ratios that people typically have more problems with. One of the problems is we have this net sales. We're going to see net sales. What does that mean? It's not net income. So we're talking about basically sales, which is revenue, the top line of the income statement, not the bottom line of the income statement. The reason it says net is because if we have the income statement broken out into detail, we may include contra sales accounts, including returns and allowances and discounts. So those are contra sales accounts. Those aren't expenses. Those are basically a reduction of sales. Those are sales that kind of didn't really happen. So remember, basically the net sales is the top line, it's the sales, and if we have a broken out into detail type of income statement, it's going to be the sales after those contra sales accounts of the discounts and the returns. Then we're going to divide that by the average accounts receivable. And this should make sense, of course, because when we think about the accounts receivable turnover, you're typically going to be thinking about, all right, what's going to be on the balance sheet? Obviously, accounts receivable, it's a balance sheet account. What are we going to be comparing that to? Well, we're going to compare that to the account that's completely related to the receivable on the income statement, which is sales. That's what happened. That's because when we make the transaction, you could think of the transaction as we debit accounts receivable and we credit sales. So those are two related accounts. So those should be the two accounts that kind of pop into your head. You're going to say, all right, we're going to do something with the sales, and we're obviously going to do something with the accounts receivable. We're going to put the sales on top because that's part of the journal entry, the main journal entry that we have when we record accounts receivable. And then the accounts receivable is going to go on the bottom. Another tricky component that often confuses many people is that we're going to take the average accounts receivable. Why would we take the average accounts receivable? Note that the sales number is an income statement account number, and it represents how we did performance-wise, therefore, as a timing account over a certain time period, such as a year. The accounts receivable account is a balance sheet account number, and therefore represents where we stand at the end of the time period, for example, the end of the year. It doesn't represent anything throughout the year. It only represents where we are at the end of the year. So if we want these two things to kind of measure in the same, to go together, then we have to think about the accounts receivable as it would be at any given point, basically, within the year. So we're going to have the average accounts receivable. The only way we can do that is think about, well, let's think about the beginning of the time period, what was in accounts receivable. Let's think about the end of the time period, and then take the average between the two, which means we'll take the beginning balance in accounts receivable, the ending balance in accounts receivable, and then divide by 2. That in and of itself is a little bit confusing of a concept, and it's also not often given when you see the ratio. In other words, when I divide this out, I'm going to have to say, okay, I do this, and then I'm going to do that kind of down here, this little calculation, and then plug that in here, right? And so you want to think about how that's going to happen, because when you go to a test question, you want to think, okay, here's the accounts receivable turnover. I have a visualization of how I'm going to make my little grid to enter this data, and I would just practice doing that. You can do it in Excel, or you can do it by hand, but the practice is to visualize how you're going to format this to save as much time on the paper as you do the calculation. Same with in practice. Here's our data. We've got the balance sheet, we've got the income statement, and we're going to need some prior year data as well in order to calculate this information. So this is how I would format this information and how I would practice basically doing this as you go through this. So we have the net sales. So the net sales is going to be the top line number. And note that we could be considering net sales. We're typically thinking we're going to take all the sales on the income statement, and that's basically assuming we have all credit sales. We should be taking credit sales, those that are reflecting the journal entry of a debit to accounts receivable and a credit to cash. A credit to sales, income, revenue, as opposed to cash sales, right? Where we would get the cash at the point of sale. They don't go through accounts receivable. But in any case, we're going to take the net sales. That's the 780 and the 898, 200. That's on the income statement. Remember, this is the timing statement. This is how we did. This is the sales that accumulated upwards, kind of like a stopwatch, up through the time period of this current year for these two companies. Then we're going to take a look at the average accounts receivable. I'm going to make a subcategory to do that. I'm going to pull that subcategory to the inside. So I've got the sales on the outside. I'm going to pull the subcategory on the inside, do the calculation of the average accounts receivable. We're going to do that having the beginning accounts receivable. And then, of course, our question is, well, where is that? Here's accounts receivable up here. Is that the beginning? No, that's the ending, because it's the balance sheet account and it's as of the current time period, the end of the current time period. Where do I get the beginning accounts receivable? In practice, it's from the prior year financial statements, because they represent the end of the last year, which is the beginning of this year. So the accounts receivable for last year is in our data down here or up here. We have it twice for some reason. And there's the 32,800. So the ending balance, last year's financial statement, is the beginning balance this time. Then we'll add to it the balance as of the end of the current year, which is on the balance sheet because these represent end of time period numbers. And then we're going to add those two up because we want to take the average of those two numbers. How do we do that? Well, we add the two numbers up that we want to take an average of, and then we divide it by how many numbers we have, which of course is 2, and that'll give us the average. So notice we have to do this whole little calculation to get to this bottom number here. Also note that this net means that if we had an accounts receivable with an allowance for doubtful accounts type of account, meaning the accounts that we estimate not to be collectible, we're saying net of the uncollectible accounts. So we would have to subtract out the uncollectible accounts. In our case, they're grouped together already. Then we're going to pull out the accounts receivable net into the outer column so that we can then calculate the outer column, which represents our formula up top. Here's our formula. Now we have net sales. Now we have the average accounts receivable, and we can calculate this out. Notice how small this formula is up top and the actual calculations you have to do down below. I would recommend really practicing every step along the way. You can obviously not write down every step. You can do this whole thing in a calculator and not write down the steps, but You want to visualize the steps for yourself as you learn these things. They can also give you more insight into what this thing is saying, as well as give some insight to the grader if you have to turn in any kind of paperwork on it to give some insights in terms of how you did the work. Plus, formatting the table will help to structure this information in your mind. So if we do this division problem, we're going to say it's the 780,000 divided by the 33600, and that's going to give us our 23.21. If we do the same calculation for B, we get the 17.5. Now, if you think about this calculation, this is the sales that happen, and the sales are what generate the accounts receivable. And this is the average accounts receivable that we have on the books. So we're dividing the average accounts receivable into the sales. And what that means is that's telling us how many times basically the accounts receivable are turning over. And that's how many times in essence they're being paid off, they're being turned over. We want this number and therefore to be higher, because that means the average accounts receivable is turning over more times. We're getting paid at a higher rate more quickly. And therefore the 23.2 for A is better than the 17.5 for B. Note that oftentimes when you look at this number, the accounts receivable turnover, it's useful to have a comparison to some other benchmark, a prior time period or another company, to give a relative relationship between the turnover for those two periods or those two companies. In this presentation, we will be continuing on with our discussion of liquidity ratios. Remember that liquidity ratios are the largest class of ratios. We want to be able to group the ratios into classes for test questions as well as for use in practice so that we have a good idea of what those ratios are used for. Liquidity ratios are used to determine a debtor's ability to pay off current debt obligations without raising external capital. So are they able to pay off their debts? Are they a going concern? In other words, are they going to be staying in business going forward, given the fact that they are able to pay off their debt? In other words, if they're able to pay off their short-term debts, we're considering that they will be in business and remain in business and aren't in trouble of going out of business or having bankruptcy problems. Those are some of the questions that we'll be considering when considering the liquidity and efficiency type ratios. Now, other ratios will include solvency ratios. So we're going to have groupings of other ratios into solvency ratios, profitability ratios, and market prospect ratios. So notice here, we're continuing on with the liquidity ratios. We're going to be liquidity and efficiency ratios include the current ratio, the acid test ratio, the accounts receivable turnover, the total asset turnover, the inventory turnover, the days sales uncollected, and days sales in inventory. We will be concentrating here on the total asset turnover, the inventory turnover, the days sales uncollected, and the days sales in inventory. For prior types of calculations, you can take a look at the prior presentation. So we're looking at the total asset turnover first. The total asset turnover is going to be represented with the calculation or formula of net sales divided by average total assets. Total asset turnover measures a company's ability to use its assets to generate sales and reflects on operating efficiency. Total asset turnover is a bit more complicated of a calculation for most people when we're learning types of ratios, because again, it will be longer when you actually do the calculation, in part because the denominator has this average in it. We have the average assets. So if we analyze this ratio, let's think about this. We have the net sales. What is net sales? That's going to be an income statement account. It's going to be the top line, not the bottom line. In other words, not net income, net sales. The reason it's net is because if we have an income statement that's breaking out the detail in the sales, we'll have sales and contra sales like allowances and discounts, and therefore those are really contra sales and not expenses. So net sales is really basically the sales or revenue top line on the income statement. Income statement being a timing account, so this represents how we're doing over time, and we're comparing that sales, basically the goal of the company to generate revenue, to the average total assets. These are all the assets. We're taking a look at everything that the company owns as of a point in time. And remember, as of a point in time means on the financial statements as of the end of the year. And therefore, in order to line these two up into the significant or same kind of time period, what we want to think about is the average assets as they might be over any given point within the year. And therefore, we want to take the average, which will be the beginning year number in terms of what the total assets are at the beginning, plus what the total assets are at the end, and then divide by 2. As we consider this ratio, remember that the goal of the business isn't to generate assets necessarily, it's to generate revenue. The generation of revenue will often reflect in the generation of assets, accounts receivable, cash, but then those assets will be given back to the company for further generation of revenue, or they'll be given in terms of dividends. The goal is revenue generation. The assets that we retain, the assets that we're holding on to, what we're doing with those assets, the reason we have them is to help us do the goal to generate revenue in the future. If the assets, in other words, aren't helping us generate revenue, they shouldn't be in the company. We should be giving them to the owner. If we have excess assets, our goal isn't to just accumulate assets. If we have a lot of assets, typically the goal is to give those to the owner or reinvest them for the generation of future revenue. So this measure then is saying this is how we're performing. This is our net performance compared to the assets, the things we have, the tools, the resources we have to help us to generate that performance. So we want the top number to be as high as possible in relation to the bottom number. The higher, in other words, this ratio is, the better we're using the assets that we have in order to generate the revenue. That's going to be the idea. Calculation of this, we're going to have the information on the left-hand side. We have the two companies. We've got A and B, two sets of data so that we can compare it. Balance sheet information, income statement information, and prior year information. Remember that as we see this in a ratio format, we also want to consider how we're going to put this together in a table. And you really want to put these together in tables. If you just know a cheat sheet or if you've got this formula memorized in your head, not really good enough, because when you start to put this together in a test situation or under pressure, you really want to visualize how you're going to put this into a piece of paper. And you probably want to do as little in your head as possible and actually write down the steps, the actual calculations, because that'll help you to double check it if you have a problem, if you don't come to the answer that's on a multiple choice question or something like that. It'll also help you to show the work in the case you need to show the work. It'll also help you to think through this actual calculation to see what it means. So if any questions that come up that are saying, what does this mean, or what does this compare to that, you can go through it and say, oh, well, it'll give you some more insight as we actually look at the calculation. So I would recommend setting up a table, something like this, and remembering and memorizing anytime you see a total asset turnover calculation, how you're going to write it down. Visualize the grid. You can do that in Excel and then write it down on paper, or you can work with on paper, but just visualize how you're going to write it. I'm going to say net sales on top. I'm going to put that into the outer column. Remember that net sales is the income statement account. So we have the net sales for A and B. That's going to be the primary goal, the objective of the income statement, to generate revenue. We're comparing that to average total assets, which I'm going to put below with a colon, because I'm going to make that a subcategory. We're going to bring that into the inner column. We're going to have to do a separate calculation for the average total assets. It starts off with the beginning assets. Now, the beginning assets aren't on the balance sheet because the balance sheet is as of a point in time, as of the end of the time period. Where do we get the beginning numbers? From the prior year financial statements. Prior year total assets are going to be the current year's beginning balance. So we look for the prior year and we look for the total assets in the prior year, and that's going to be the number that we're picking up for both A and B. We're going to add that to the ending balance. The ending balance for total assets is, of course, on the current balance sheet because the balance sheet is as of the end of the time period. So that's going to be from the ending balance here for the total assets. We're going to add those two up. Why? Because we want to take the average of them to get the average time period over any point within the time frame that's being covered. In this case, the year's time period. So we divide by 2. That gives us the average. I'm pulling the average now out to the outer column so that now we can compare what this actual ratio is, which is the net sales divided by the average total assets. And then we get our numbers. And remember, you have to think about how many decimal points we're breaking this out to. So we got 780,000 divided by 450,370. We broke it out to 1 decimal, which is going to be the 1.7. So once again, think about what we're using here. This is going to be our total assets that we're dividing into the net sales. So this is the tools we have in order to achieve the performance that we want. And so we want this to be, the higher this number then, the better our performance is compared to the lesser amount of assets, the more efficiently we would be using the assets. So in this case then B is looking better than A. Inventory turnover. So we'll take a look at the inventory turnover, which will be the cost of goods sold divided by the average inventory. As the name indicates, the inventory turnover measures how long a company holds inventory before selling it. So how long are we holding on to the inventory? So we typically want a higher inventory turnover because a company with a high turnover requires a smaller investment in inventory than one producing the same sales with lower turnover. Now, when we consider the inventory turnover, we have another type of calculation that's going to be a bit more confusing, in part because we have a balance sheet account and an income statement account. And the balance sheet account, like many of them, we're taking an average balance sheet account. When we consider the inventory turnover, we should intuitively think of these two accounts because inventory, of course, is an asset account. It is what it is. We know that that account's going to be there because we're talking about inventory turnover. The other side of inventory is cost of goods sold. And remember, that might not be quite as intuitive because when we think of the sales journal entry that has both a sales and an inventory component. When we make a sale, we debit the accounts receivable, we credit sales. And then the other side, the inventory side, is we reduce inventory with a credit and we debit cost of goods sold. So these two are related. They're part of the journal entry that we would consider when we make basically a sale. They're the expense of the inventory and the inventory assets going down. So we're going to be comparing those two with the inventory turnover. The top is going to be the cost of goods sold. That's going to be our income statement account, our timing account, the performance account. How are we doing over time? It's an expense. So we're talking about the expense of the inventory. We're going to divide that by the asset account on the balance sheet. The asset account on the balance sheet, which as of a point in time, as of the end of the time period. In order to line these up, we want to take the average inventory, which will give us basically the average balance at any given point in time throughout the time period, and therefore we take the beginning balance, add it to the ending balance, and then divide by 2. Let's take a look at an example. We have our information, balance sheet, income statement, prior year data, and we're going to take this information and visualize it once again in a table format. It's going to look a lot longer because the table format, we're going to calculate and show each of the line items, and I do recommend visualizing this as you practice. So we've got the cost of goods sold, top line item, that's on the income statement. Second line, first expense account, the biggest expense account, typically representing the expense related to us selling the inventory. And then we're going to have the average inventory, which I'm going to put a colon and a subtotal, bringing those into the inside, doing a calculation separately for them. We have the beginning inventory. Where's that going to come from? Not the balance sheet on the current year, because the inventory on the balance sheet in the current year is as of the end of the time period. We need to go to the prior year. We're looking for the prior year ending balance because that's what the balance sheet is as of the end of the time period, which is the current year's beginning balance. That's why we have the added data here. We're going to add that to the ending balance for inventory, which is on the current balance sheet because the current balance sheet is as of the end of the time period. We're going to add those two up. Why? Because we're doing an average. So we're going to add the two up and then divide by how many numbers we have, which are 2. And so we'll divide by 2. And that'll give us the 70,920. I'm going to pull that out into the outer column so that now we have our two components for the ratio, that being the cost of goods sold and the average inventory. Cost of goods sold divided by the average inventory. If we calculate that out, 592,100 divided by 70920, that gives us the 8.34. The 8.3, we're calculating it out to 1 decimal in this case. So let's think about this again. We've got the average inventory. This is the average inventory on hand at any given point, basically within the time period that we're talking about. We're dividing that into the expense of us basically selling the inventory. So this is representing us selling inventory. This is representing us how much inventory is currently on hand. And so if we divide this into the cost of goods sold, we're calculating how many times that average inventory is turning over. And we would like to have it turn over more generally, because that would mean that we're selling the inventory and not holding on to it as much. We would rather be selling our inventory faster and spending less time and effort and money and risk holding on to the inventory for a longer period of time. So in that case, then A is looking better at the 8.3 than B at the 5.2. Next, we'll take a look at the days sales uncollected. Days sales uncollected is going to be the accounts receivable net divided by net sales. We're going to take that and multiply it by the number of days in the year, 365. So once again, we have the accounts receivable net. That simply means that we're going to have the accounts receivable net of any allowance for doubtful accounts, the contra account that we think are going to be uncollectible receivables, or the estimated amount of uncollectible receivables. We're dividing that by net sales. Once again, net here does not mean net income. top line sales revenue item is what we're talking about, but net of contra sales accounts such as allowances and discounts. So notice what we're comparing here. We have the days sales uncollected. So how long are the sales going to be uncollected? In other words, giving us an average of how long it takes for us to collect on the receivables. And as we consider this number, we of course want to consider it with regards to the terms that we have when we usually make a sale. In other words, how long do we usually give our customers to pay off a credit term? So if we make a sale on credit, do we expect to be paid within 30 days, 60 days, or what's going to be the standard? And then we can compare the day sales uncollected to those credit terms, and that'll give us a better idea as to whether it's a good or bad number. But mostly, generally, we want to get paid earlier rather than later because of the time value of money. As we consider this ratio, of course, we're thinking about the accounts receivable, that representing the account that people owe us money for, and we're comparing that to the related account to it, which is going to be the sales item. This is what we would expect because this is the normal journal entry we would see. We would see when we make a sales type journal entry or something related to accounts receivable, we debit accounts receivable and recredit sales. Note, however, what might be a little bit unexpected compared to some of the prior ratios we have is that although we have an income statement account and a balance sheet account, we're not taking the average accounts receivable. We're taking the accounts receivable as it is at that point in time on the current financial statements as of the end of the time period, generally when calculating the day sales uncollectible number. Let's take a look at an example. Here's our data. Here's the balance sheet. Here's the income statement. We're going to be calculating first the current receivables. So the current receivables are the $34,400. Note, once again, not the average, but the receivables on the balance sheet of the current time period. And here they are, the $34,400. We're going to take that and divide it by the net sales. The net sales are going to be on the income statement. So here's our net sales. We're going to divide those out and we're going to get the subtotal, in our case, of the 0.04. So we'll divide that out by 34400 divided by 780,000. And we always have to deal with the rounding. So remember that rounding is always going to be a factor. We'll take that and multiply it times the number of days in a year, this being 365, and that'll give us our 16.1 and our 21.3. Typically, we would want to get paid earlier rather than later, so the 16.1 for A will typically be better than B here. But note, again, this is going to be relative to the type of industry and the credit terms that we typically offer, because, of course, some businesses just by nature will have longer collection periods than others. But if we're looking at related types of businesses, we're looking at period to period, we would rather basically receive our receivables earlier, if nothing else, because of the time value of money and the reduced risk with getting the money earlier rather than later. We now have days sales in inventory, giving us an estimate of how long it takes for us to sell the inventory. And of course, we want to be able to sell the inventory generally sooner rather than later. That's going to be the general rule. We have the ending inventory. We're going to divide that by the cost of goods sold and once again multiply that by the number of days in a year, or 365. When we see the ratio such as this, we should consider and keep in mind, or have in our mind, that we're going to be dealing with these two accounts oftentimes because they're related within a journal entry. You can think of how are we going to record a journal entry related to inventory? Well, when we make a sale, we debit accounts receivable, recredit sales, and then we have the other side related to inventory, crediting inventory and debiting the related expense to it, cost of goods sold. So when we think about inventory and a ratio related to it, we're probably guessing it's going to have to do something with cost of goods sold and inventory. We're going to have the inventory on top. That's going to be the balance sheet account. Remember here, we're not taking the average inventory here. We're just taking the ending inventory, which is on the current financial statement, dividing that by the income statement account, the expense related to us selling the inventory, or cost of goods sold. We're going to take that number and multiply it by the number of days in the year, that being 365. Let's take a look at an example. We have the balance sheet. We have the income statement. We want to visualize how to format this information. We're going to start with a merchandise inventory, not taking the average, but simply the inventory on the balance sheet. That's going to be the ending balance on the balance sheet. Then we're going to have the cost of goods sold. That's going to be the income statement number, the timing number, the expense number. We're going to divide those two out to get to our subtotal here, which we're then going to multiply that by the days in a year. 84240 divided by the 592100. That's going to be the 0.142 times the 365. Note you're always going to have to deal with rounding here, so just be aware that we'll always have that kind of rounding issue. That's going to give us the 51.9 and the 78.6. Now, typically, we want to generally hold on to our inventory less. So the turnover that's going to be faster, in this case B, means that we're typically holding on to the inventory for less time period, generally a good thing. Hello, in this lecture we're going to talk about the current ratio, the quick or acid ratio, and working capital. We will be able to calculate the current ratio, calculate the quick or acid ratio, and calculate working capital, analyze what these ratios mean, and describe the effect that different transactions will have on these ratios and why. So first, let's take a look at, we're going to go through a problem and look at some different transactions and see what the effect would be on different types of ratios. We're going to look at a trial balance in order to calculate the ratios rather than financial statements, because I think it's good to always go back to the trial balance, look at the calculations in terms of the trial balance, as well as to look at some adjustments on the trial balance and see what the effect of those adjustments are on the trial balance, and therefore what the effects will be on the ratios. Ratios are going to be really important in a lot of different areas, whether we are going to be doing accounting or just about anything where you're measuring just about anything. Because when you're measuring things that aren't lined up precisely, then the only way to try to discuss things and compare things out, or one of the best ways, one of the greatest tools, are ratios. So this will be demonstrated in things like baseball or any type of sport. If we're trying to compare which player is better, can't do it without some type of ratio analysis. In the job, even if we're not in the accounting department, if we're just trying to measure people's performances during different aspects and different performance, we have to use ratios. So they're really important to know. It's basic math, it's just division problems most of the time and some basic algebra, but many people get to the point where they can calculate ratios and they can do the math. However, we also have to interpret the ratios, and that's when it gets a little bit more complex for most people. So general ratio analysis is that we will calculate the ratio, and then we're going to try to explain what the ratio means. And oftentimes, even when you do this a lot, you start to say, well, that ratio went up because the numerator went up and the denominator went down. And that doesn't really tell you anything. That's just the mechanics of the ratio that happened. So what we're going to do is calculate it in terms of a few transactions and see what the effect is on these ratios, and then maybe that'll help us to do the more difficult part most of the time, which is to interpret what the ratios mean, see what different transactions would do to different ratios, and why. Some of the most common ratios are going to be these type of liquidity ratios, which are going to be the current ratio and the acid test ratio. So those are some very common and useful ratios that are going to be used all the time. They're probably some of the most asked ratios. So those are going to be some really good ones to take a look at and try to analyze what different things will do to those ratios, and then take those same principles and think about more types of ratios that could tell you a lot of different types of things, and try to see why and their ratios would be used and how they would be affected by different types of transactions. So you can see here we've got a trial balance, we've got the assets in green, and we've got the liabilities in orange, and we've got the equity in the light blue, and the income statement being sales, income, and expenses in the darker blue. The debits are going to be represented without brackets, and the credits will have brackets. Therefore, the debits minus the credits will equal 0. That will give us a quick balancing way to give us our double entry accounting method and see that we are in balance. We can also see the net income very quickly in this type of method, seeing that the credits of sales minus the debits of the expenses mean that we have income, not a loss, a credit balance, which is good on the income statement, of 207 at this time. We also have our calculations up here. We're going to have our normal accounting equation, assets equal liabilities plus owner's equity. That's basically our balance sheet accounts here summed up. So the assets, of course, are all the green accounts, liabilities, all the orange accounts, and equity, all the blue accounts, including retained earnings and all of the income statement. Then we're going to break those assets down into our quick assets and our current assets. So what are current assets, what are quick assets? Those are going to be part of our calculations when we start talking about our current ratio and our assets test ratio. So first let's define what current assets are and quick assets. Current assets are going to be more liquid assets. These are liquidity ratios, meaning they're going to be closer to cash. They're going to be things that are going to be closer to the point at which they can be used in order to exchange for paying off things like our liabilities. So that will include cash. It's going to include accounts receivable. It's going to include the allowance, which is related to the accounts receivable. It's going to include inventory. It's going to stop at basically machinery, which is going to be property, plant, and equipment. So it's going to include all these things up here. These are going to be the current assets, meaning that we expect them to be converted to be fairly liquid and converted to cash fairly soon so that they can be used to pay off our obligations that may be coming up. Of course, when we get down to machinery, even something like inventory, if we take a look at inventory, even inventory, we can say, well, that's not, we can't pay our bills with inventory, but we do expect the inventory to turn over relatively soon, hopefully, and thereby be converted to cash, in which case it's more liquid. As opposed to something like property, plant, and equipment, if we're talking about a building or something, we never expect to sell the building, liquidating the building, and get cash for it. We expect the building to continue to help us generate revenue in the future. That's what the building's for. But we're never actually going to liquidate basically the building unless we close the company. So those are non-liquid assets, very important assets, and non-liquid assets, not something that we can pay off our liabilities with. If we look at the quick assets, then we're going to be more restrictive. We're going to say, yeah, I'll give you cash, I'll give you accounts receivable and the allowance to it, but I'm going to take off that inventory. We're going to say, you know what if there was a complete downturn and we couldn't sell anything anymore because there's there's a depression or something, then we're going to cut down the inventory and just think about assets that are very more liquid, being just the cash and the receivables. So that's going to be that. On the liability side, we're going to say what are current liabilities. Now, note that we usually have less liabilities here, so the current liabilities are going to be the liabilities that are going to be due within a year. So in this case, that's all we have at this point. We've got accounts payable due within a year. We have dividends payable, which are usually current. And notice the notes payable are usually the ones that we think could be long-term. It depends on the term of the note, however. So many notes oftentimes have a current portion and a long-term portion. If we think about something similar to a mortgage type note, then we pay that off monthly. The amount that's going to be due within 1 year, the definition of a current liability is it's going to be due within 1 year. That would be a current portion of that particular note. Anything due past 1 year would be long-term. So we're going to have notes. We're going to have to break the note out between current portion and long-term portion. The definition of a current liability means it's going to be due within a year. Why a year? I don't know. It's a complete arbitrary judgment that we picked. Someone picked a year. So the current liabilities means a year. And it makes sense because, a year is a nice even number to use. But it is arbitrary. We just said, current liabilities means it's going to be due fairly soon, a year. It's going to be due within a year. And so that's our comparison. You can see why we would want to compare those things, because current liabilities means we are going to have to pay something within a year, and we're going to have to pay those with cash, which means that we need something that's going to be converted to cash or be cash fairly soon so that we can use it to pay off these liabilities. So if we just took these numbers then and we did our calculation here, then we've got our current assets, which we just said was this plus this minus this plus this. And then we've got our quick assets is this plus this minus this, not including this. And that's always going to be a lesser number, you'll see. And then we've got the current liabilities, which of course just is the 120. Now if we calculate our current ratio, this will be the formula we will use. And I know it's very well written here. We got the current assets over the current liabilities. Current assets divided by the current liabilities. That's going to be the ratio that we will be looking at through this whole time here. So we're going to take a look at that at this point. Pull out the calculator, and we have current assets of 300,000, current liabilities of 120,000. That means we have 2.5. So we have a 2.5. What does that mean? So that's the answer. We got a 2.5, and what that means is if the current assets being 300,000, if we think about that as basically it's going to be cash at some point. If that was all converted to cash, we'd have $300,000. Current liabilities, stuff due within a year, if like that was all due now and we had to pay cash for it, we'd have to pay that 120. So what we're saying is that 120 can go into that 300 2 times and a half. So we can pay it over 2.5 times. That's pretty good. Seems pretty reasonable to have that. We feel fairly liquid. We're not going to basically go bankrupt on that. So that seems good. Let's take a look at the acid test ratio, where we're going to take the quick assets, which of course are less because they're not included in the inventory, of 168,000 divided by the same current liabilities, 120,000, we get 1.4. More restricted number of here, of course. So now we're saying how many times can we pay off our current liabilities with just the quick assets. And of course, that's going to be a lesser amount. We can pay it off a whole time over plus 0.4 more. That's going to be the idea of the quick assets. And depending on what type of industry we are in, we'd want to be able to compare these two different types of industries. Now, the working capital is just going to take the current assets minus the current liabilities. So if we took that, we're going to say we have 300,000 current assets minus the current liabilities 120. That means we have 180 kind of left over after that. Now notice that this number is a really good number for our internal use, for us to compare period to period for our internal performances, and we'll know what that number means, and that's a good number to have. However, we cannot really use this number of working capital too well to compare us to other companies, because other companies have different standards. So for example, if we have a hamburger place and we're trying to model our hamburger place to like McDonald's or something like that, we cannot use the working capital. We can't, because just the scale of their operation is larger than the scale of ours. Does that mean that we cannot benchmark to someone like McDonald's if we are starting up a hamburger shop? Not necessarily. We could use other measures to do that. We can't use numbers like this because the scale is totally out of whack. However, if we wanted to compare our relative performance to somebody else at a different scale, then we can use the ratios. So that's what the ratios are for. So this is why we really have to. We can compare the ratio analysis of the McDonald's current ratio and their quick acid ratio to ours, and that's something that we can take a look at. We can say, hey, there should be different because this or that reason, but we can use the ratio and it'll have meaning to us when we compare across different scales of things, as opposed to if we use a number like the working capital. However, of course, the working capital is good for internal use. All right, so let's take a look at another calculation. So we're going to say now that we sold merchandise, a normal type of transaction, sales price being 110,000. We sold it for cash and it cost us 70,000. So we sold merchandise. So let's think about that transaction. Let's see what happens to the trial balance accounts. Then let's see what happens to our ratios. So if we sold it for cash, what's going to happen to cash? Cash is going to go up. Cash is a debit balance. We're going to make it go up by doing the same thing to it, which is another debit. We're going to debit cash. If we sold something, we earned revenue. If we sell stuff, we usually call revenue sales. That's down here on the income statement. Sales has a credit balance. We're going to make it go up by doing the same thing, which is a credit of that 110. Then we got the 70,000 cost. What did we have to give up? We gave up inventory. So inventory is a debit. We need to make it go down because we gave it up. So we're going to do the opposite thing to it, which is a credit. And then we got to debit the expense related to that inventory. So if we look at the journal entry, then it would look like this. Cash is going up. We're going to debit cash, and therefore cash is going to go up by the 110, and it's going to go up to the 190. So we did the same thing to it, increasing cash. Sales, crediting 110. So sales has a credit balance. We did the same thing to it, crediting it, making it go up to 510. Of course, that increases net income, which is sales minus the expenses. On the inventory side, we had to reduce the inventory. Inventory has a debit balance. We did the opposite thing to it. We credited, making inventory go down. And then we had to expense through cost of goods sold the inventory through the use of it. So we have the cost of goods sold goes up like all expenses do. They pretty much always go up in the debit direction to the 150. So if we break this down then, what happened? Well, net income went up by the 110 and down by the 70, or a net increase of 40. That's going to be the gross profit from the sale that we just made. So it went from the 207 we had before up by the 40 to the 247. And the assets overall, if we take a look at the assets overall, they went up in cash by the 110, and they went down by the 70. So again, net change of the 40 for the asset overall here. So if we go through this now, if we look at our current assets, this is what we had last time. If we look at our current assets, our quick assets, and our current liabilities and compare what happened from last time to what's going to be there now, then we can see that the current assets are going to go up by the cash of 110. That's a current asset. Inventory is also a current asset. These are all current assets up top. So it's going to go up it's going to go down in this case as well. So there's going to be a net change of that 40 again. So that means that the current assets are now at 340. How about the quick assets? Well, the quick assets are going to go up by that 110. However, the merchandise inventory is not part of the quick assets. So that 70 is not going to affect the quick assets. So it's going to be at the 278,000. Current liabilities here, we can see that there's no effect on the liabilities in this instance. So we keep that the same at the 120. So now let's calculate our new ratios in this format. We're going to come out to 2.83. Let's see what that looks like. So we're going to calculate our current ratio. So we're going to take the current assets, 340,000 over current liabilities, 120,000. That gives us our 2.833. Notice it's not even. That's okay. We're just going to round it, and we usually round it to two places. That's very common. You're going to want to look at the problem to make sure what they want to round it to, however. And then the asset ratio, let's take a look at that and see what the effect would be. So we've got the quick assets, 278,000 over, and then we've got the current liabilities being the 120,000. We get the 2.316, and obviously we're going to round that up because of the 6, going to make that a 2. And then we're going to have the working capital being the current assets of 340,000 minus the current liabilities of 120,000, or the 220,000. So notice this does kind of what you would expect, right? When we make a sale, we like selling stuff, and that improves, it increases both our current ratio and our acid test ratio. It increases the acid test ratio by more because of the fact, of course, that the merchandise inventory is not included in the acid test, and therefore the numerator here went up by the 110, whereas the numerator here only went up by the 40, the difference between the 110 and the 70. All right, let's take a look at another one. We got the 5.4, collected cash on accounts receivable. So now we're going to collect cash. So if we're going to think about that, is cash affected if we collected cash on the receivable? Yeah, cash is going to go up. We've got 190. We're going to make it go up by doing the same thing to it. This is a debit, therefore we're going to debit cash. And we collected it because we're paying off, someone's paying off of their receivable to us. And so therefore we had 150 owed to us. Someone paid us the 90. So we're going to take that debit, reduce it by the 90. So we're going to credit receivable. Journal entry will look like this: debit cash, credit receivable. So if we think about that, then we have the cash here going up by that 90. So here's the 90 debit to cash, increasing the cash. And we have the receivable at 150 going down by that big 90 down to 60. And I realize that the allowance account being larger than the receivable looks somewhat funny here. So our allowance is looking a little out of whack, but that's okay for now for our analysis. So if we think through this in terms of assets, liabilities, and equities in terms of our prior numbers, this is where we were as of the end of last time. If we think of total assets, we know that total assets went up and total assets went down. So one asset went up, one asset went down. There's no change in assets, no change in any of the liability accounts, no change in the equity accounts. So no change in our total accounting equation. How about in our current assets and our quick assets? Well, in terms of our current assets, we can see no change because these are both current assets. So everything down to here is a current asset. The current asset went up, the current asset went down. Now, we are more liquid. We're more better off here because cash is more liquid than the receivable. However, they're both considered current assets in terms of that level of liquidity. So even though we are better off with this transaction, it's not going to affect the current assets in this case. How about the quick assets? Well, the quick assets don't include inventory, but there's no, we're talking about receivables and cash, and those are both quick assets, no change to the quick assets. So therefore, liabilities, we got no change. We just said no change to any of the liabilities, and there's no change to the current liabilities. The current ratio then, it's going to be the same. So we're just going to say the current ratio then would be the current assets of the 340 divided by current liabilities of 120. And that means that we have the same 2.8. So we can pay off our current liabilities 2 times and 83% of another time over using our current assets. How about the quick acid test ratios? Same type of idea here. So we're going to take the quick assets, which are the 278,000 over the 340,000. That'll give us, wrong number. We're going to take the quick assets, 278,000 over the current liabilities of 120,000. That gives us our 2.31, and we're going to round that so we can pay over our current liabilities 2 times and 32% of another time with our quick assets. And then we're going to take our working capital, which is going to be the 340,000 current assets minus the current liabilities of 120,000, gives us that 220 there. All right, let's take a look at another one. So now we're going to be here. We're going to purchase merchandise inventory on account. So we're purchasing stuff on account. So is cash affected? No, we purchased it on account. That means that we purchased it with, in this case, accounts payable. Now, sometimes it's easier to think about what we received in order to think about debits and credits. So what did we receive? Merchandise inventory. It's an asset. It has a debit balance. We need to make it go up. Therefore, we're going to do the same thing to it, debiting merchandise inventory. If we debit that, that means we must be crediting the payable. The payable has a credit balance. If we credit it again, it's going up because we're doing the same thing to it, which makes sense because kind of like the bad thing's going up, the liability is going up. So it would look like this. We're going to debit merchandise inventory. We're going to credit the accounts payable. If we think through that, then if we post that, then the merchandise inventory is going to be a debit. It's going to go from a debit here. We're going to post the 160 and bring it up to this 222,000. The accounts payable has a credit here. So it's a credit of 120. We're crediting it again, making it go up to the 280,000. All right, so let's break that out in terms of our accounting equation, and let's compare it to where we were at last time. All right, so if we think about our total assets, which are all the green accounts, we know that that, of course, went up. The total assets increased because we increased the merchandise inventory. Liabilities went up because we increased the liabilities here, and the equity has no change. So then if we think of the current assets includes this, and the inventory. Therefore, inventory is included. Inventory went up. Current assets are going to go up. So current assets increase. Notice that's part of our ratio down here. The numerator will change for the current asset ratio. How about the quick assets? Well, quick assets do not include inventory. So inventory is not included in the quick assets. Therefore, quick assets stay the same. So they're going to stay the same here. How about the liabilities? Our current liability, we know that total liabilities go up. Also current liabilities because it is accounts payable. So liabilities are increasing. That's in both of our ratios that we're talking about. So there we have, notice what happens here in our current ratio, the current assets and the current liabilities go up by the same amount. In the quick test ratio, the asset test ratio, the quick ratio, the quick assets stay the same, then the numerator stays the same, the denominator goes up. So you can see there's going to be a different type of effect on that because of the fact that the inventory is not included in the quick assets as it is included in the current assets. So let's see what that does to our ratios. So we're going to take a look at our current assets. It's going to be now 500,000 over the current liabilities of 280,000, and that's the 1.78. Notice that it went down even though the same dollar amount was in effect on both the numerator and the denominator. If we take a look at the quick assets ratio, or the acid test ratio, we're going to take the quick assets of the 78,000 over the current liabilities of 280,000, and that will give us the 0.99. Notice we are below 1 there. Why? Why is it below 1? Because now the quick assets are less than the current liabilities. If we had to pay off the current liabilities with just the quick assets, we couldn't do it. So we generally want the number to be over 1 most of the time because that means that we can pay it off with the quick assets. But that doesn't necessarily mean we're in trouble because we have a lot in terms of current assets because of the inventory. So you can see that this type of transaction is going to have a large effect on the difference between the current assets and the quick assets when we buy the merchandise inventory on account. There's going to be no change to the working capital because now we have the 500,000 less the current liabilities of the 280,000, and we remained at the 220. All right, let's take a look at the next one. We're going to borrow 100,000 cash from a bank to be paid back in 6 months. All right, is cash affected? Yeah, we borrowed cash, so cash is a debit balance. We're going to make cash go up by doing the same thing to it, which is a debit. And we're going to credit, in this case, note payable. Now notice we have 2 of them down here. What's the difference between a short-term note and a long-term note? The short-term means it's going to be due within a year. So remember that it is possible, and like as we have in this case, a note to be due within a year. So that means it's not a long-term note payable. It's a short-term note payable, even though it's a note, because we may have to pay interest on it and we may have to have formal documentation on it and whatnot, which would separate it from an accounts payable. So here's the journal entry. Cash is going to go up. Cash to debit is going to go up by the 100, goes up here to the 380, and then the other side being the liability. So the liability being 0 going up to 100 in this case. Let's see what happens to our accounting equation, our accounts. Let's compare it to the prior position. So if we think of assets, assets of course went up because if we look at the green accounts, we can see that the cash went up. Liabilities went up because we can see that the orange accounts went up in the credit direction. So liabilities are going up. Equity, no effect on the equity. How about the current assets? We know total assets went up. How about current assets? Well, yeah, cash is a current asset. So if that's the one that went up, then the current assets are also going to go up, as we can see here. And then how about the quick assets? Well, yeah, cash is also a quick asset. It's about as liquid as can be, so it still qualifies as a quick asset. Therefore, the quick assets are going to go up by that 100 as well. Current liabilities? Yeah, that's the current liability. That's the question this time because it was a note. However, it's due within 6 months. Therefore, it's current. Current liability is going up to 380. So if we look at our ratios, then the current ratio is current assets over current liabilities. Current assets went up. Current liabilities went up. If we look at the quick ratio, quick assets went up, current liabilities went up. So both the numerator and the denominator going up by the same dollar amount in each of these calculations at this time. So let's calculate this out and see what we have. So the current assets being the 600,000 divided by the current liabilities, 380,000, gives us the 1.57 blah blah, which we're going to round out to 1.58 as we have here. So even though there was a similar dollar amount change, it still went up and went down, sorry, in this case. And then we're going to take a look at the acid test ratio. So let's see what it comes out to. It's going to be the same here. So let's see if that is the case when we do the calculations. We're going to say the quick assets are going to be the 378,000 divided by the current liabilities of 380,000, and so that's still the 0.99, and then we can calculate the working capital being the 600,000 minus the current liabilities of the 380,000 being the same at the 220. All right, let's do one more. I believe this is the last one. We're going to borrow 150 cash from bank to be paid back in 3 years. So once again, we borrowed cash, the only difference being that there's a longer payback period here, 3 years. So cash is affected. Cash is going to go up. We got more of it. We're going to debit cash. We're going to credit a note payable this time again. However, We're debiting the long-term note payable this time because it's not going to be due for a year, more than a year. It's past a year due. And notice that a lot of us might be familiar with monthly payment type notes, but we could design a note any way we want, and we could say that the principal amount is not going to be due for over a year. We're not going to pay any principal on it for over a year, and therefore it would all be long-term portion of the note. And the journal entry would be an increase to cash. So we're going to debit cash. Cash goes up with a debit to here. And the liability is going to be a credit. So here's the long-term liability now. Down here, increase in the long-term liability. Let's see what that will look like in terms of our accounting equation. Let's compare it to what happened or where we were at last time. All right, so we can see that assets are going to go up because cash is an asset and cash went up. We can see that the liabilities, total liabilities, are going to go up because we have an increase in these orange accounts, an increase in the liabilities here. We can see that equity is going to stay the same once again. How about current assets? Current assets, are they going to go up? Yeah, because cash is current. It's going to be a current. So current assets are going to go up as well. How about quick assets? Another subcategory of assets. Yeah, quick assets are still going to go up because cash is a quick asset as well as a current asset. It's about as liquid as can be. So we're going to say the quick assets are going to go up. How about, we knew that the liabilities go up, but how about the current liabilities? And that's the course where we have the difference here. So we know that the current assets are going to go up. The numerator will go up here. The numerator will go up here. But the current liabilities, because this is over a 3-year note, will not go up. And therefore, we're going to stay the same on the current liabilities like so. And that's what's going to be the effect on our ratios here. So let's see what happens to our ratios. Looks like it's going to have a positive effect on the ratios. Let's see if we do the calculation, if we come up with the same thing here. We're going to say the current assets are going to be now the 750,000 divided by the current liabilities, which are the 380,000. So now we come up with the 1.97. So we're now better off, meaning we can pay off our liabilities 1.97 times over, 1.97% of another time over with our current assets. And that would make sense because what happened is we said we increased cash and we pushed the debt out to a longer time in the future. So that's one way we can improve these ratios, which isn't a long-term strategy because obviously we can't do that forever, but that is a way to keep us in a short-term liquid position. If we can't pay our current obligations and we want these ratios to look better, we can take out a longer-term note. We can push some of those liabilities out into the future. So we do the same thing with the asset test. We're going to do the same type of calculation. That's also looking much better, which is over 1 now, which we generally like to see on both of these ratios, like to be over 1. So if we take the quick assets being the 528,000 over the current liabilities of 380,000, we now have the 1.3938, blah, blah. We're going to round it to 1.39. And then we've got the working capital, which has also going up here. And that's going to be the 750,000 current assets minus the current liabilities of the 380,000. So that's going to be that one. Now note the difference between this one and of course the last one being long-term note versus the short-term notes. So those are some of the effects that some of these transactions can have, and you get some idea of how the journal entries will be affected by different transactions, which could help when analyzing these transactions. So now we are able to calculate current ratio, quick and or asset ratio, and the working capital, as well as analyze what these ratios mean and describe the effect that different transactions will have on these ratios and why. In this presentation, we will take a look at and practice calculating solvency ratios. Remember, as we consider ratio analysis, we want to be able to group the ratios by category, that making it easier for us to know what those ratios are doing, communicate that to other people, and it's going to be easier for test questions, common test questions being to group the ratios into categories. We looked at liquidity and efficiency. We're now going to be looking on solvency ratios. Solvency represents a company's long-term financial viability and its ability to cover long-term obligations, as opposed to liquidity and efficiency, where we were considering the short-term obligations. Is this company going to be able to pay off its short-term obligations, the debts that are going to be within a year? That was the liquidity ratios. Now we're looking at solvency, where we're taking the more long-term perspective. Notice that between these two ratios, one way to kind of solve the liquidity problem, if you're having issues paying the short term, is to put that the obligations more into a long term. In other words, take out more long-term loans, for example, rather than the short-term loans. That'll help you out in the short term. We'll be able to be in business and achieve our short-term obligations, but it will be not good for the long term, and we'll see that problem within the solvency calculations. When considering solvency, we're often taking into consideration the capital structure, or the structure between the liabilities and the equity. So we'll be dealing with equity and liabilities oftentimes when we're considering solvency calculations. And the reason for that is, of course, because the liabilities and equity represent who has claim to the assets. So the equity represents the claim, or the net book value of the claim by the owners, versus the liability, which represents the claim by third parties. So the differentiation between how much of our total assets, in essence, are claimed by third parties versus how much is going to be the net value or claimed by the owners is going to be one of the initial components, or the main components of the solvency type calculations. We then have profitability calculations and ratios, and market prospects. We'll be taking a look at those two in future presentations. What's going to be included in solvency ratios will be the debt ratio, the equity ratio, the debt to equity ratio, and the times interest earned. So we're going to start off with the debt ratio and the equity ratio. We're going to combine these together because they're going to be easier to see as we combine them in one place, so we can see the relationship between them as we do so. The debt ratio is the total liabilities, or the debts, the total liabilities, the debts, divided by the total liabilities and equity. So let's think about that for a second. We're taking total liabilities, it's the debt ratio. The debts on the balance sheet are what we owe. Total liabilities including both the current and the long term. So we're not breaking out current and long term. We're looking at the total liabilities, comparing that to the bottom line, which is the total liabilities and equity. Remember that the accounting equation is assets equal liabilities and equity. So this number, liabilities and equity, is the same thing as total assets. In other words, we can think of it as what the company basically has, who has claim to those total assets. This ratio giving us the percentage that will be liabilities as compared to equity, which would kind of represent the owner. So the equity ratio then is going to be the total equity, the second part of the liabilities and equity, divided by total liabilities and equity. So given these two components, total liabilities and equity is made up of total liabilities and total equity. So therefore, these two ratios will add up to percentages that will add up to 100%. And we're breaking out the percentage of the 100% total liabilities and equity, also representing basically total assets, and saying what portion of that is being attributed to liabilities, third parties, people that we have to owe or obligate that aren't owners of the company, versus owners of the company, which represents the equity or the book value in the company, total equity. Let's take a look at an example. Here's going to be our data. All we need is the balance sheet in order to do this calculation. We got the assets, liabilities, and equity, and we're going to do this for A and B. These are going to be two sets of data. We can think of them as two different companies. Easiest way to do this is to break out in a vertical type of fashion. We're going to take the total liabilities, the total equity. So we're just taking the bottom line, the total liabilities, which is going to be the sum of the current and the long term. We don't have the subcategories broken out here. So we're going to calculate this as the 61,340 plus the 82800. That's going to be our total liabilities, including the current and long-term portion. Then the equity represented here by the 170,000 common stock and the 198,600 in retained earnings. That's the total equity. And that's going to, if we add those two up, we get the 512,740. So that is our liabilities and equity side of the balance sheet. We have the liabilities and equity is the total bottom line of the balance sheet, the 512,740, which is equivalent to the total assets. Then we're going to do a comparison, a ratio of each of these components compared to the total, and we'll get a 2872 breakout. In other words, we can take each of these components and compare it to the total, or the 144140 divided by the total of 512740, and that gives us a 28%. And then on the equity side, we take the 368600 divided by the total 512740, and that's going to give us the 72% about. And of course, those two add up to the 100%. So if you consider this calculation, we're thinking of the total liabilities and equity, which also represent the total assets, and we're saying who has claim to those. Is it a third party, liabilities, debt, or is it the owners, in essence, the book value of the company represented by equity? In this case, we have the 28% represented by the liabilities and the 72% represented by the equity. Let's take a look at B, where we're going to pull this information, and we're taking the of the liabilities, the 100,300 plus the 107,000, and that's going to be the 2073. The equity represented by the common stock of 196,000 and the 136,750 of retained earnings, the 332,750, and then we can do our ratio analysis compared to the total. So obviously the 207,300 plus 332,750 adds up to the 540. 50, and then we could do our ratio compared to the total, which is the 207,300 divided by the total 540,050, and that's going to be the 38%. Always have to deal with the decimals. This is unlikely to come out even. And then the second total is going to be the 62% about, and that comes out to 100%. So if we break out again like our total equity or our total assets, same kind of thing, and say who owns it, 38 for the debt liabilities versus the 62 for the equity. So obviously, and this type of calculation is considered to be better, less risky if we have the higher equity. So the 72% equity here in terms of A looks better than B. Then we can have the debt to equity ratio, which is going to be similar but slightly different. We're taking the total liabilities, the debt, dividing that by the total equity. So note what we have here, it's a little bit different. We're not dividing by the total equity and liabilities, the bottom line of the balance sheet. We're dividing by the equity, which you can consider as the book value of the company. Assets minus liabilities equal the equity. So this, in essence, is what the owner has claim to, and we're taking the debt, the current debt, divided by what, in essence, the owner has claim to. Let's take a look at an example. We have the debt to equity. We're going to take the total liabilities. So the total liabilities is going to be the top line. And once again, we're going to add up the liabilities. I won't do it again, but it's going to be the 61,340 and the 82,800 total liabilities, both current and long term. And we're going to be comparing that to the total equity. I won't add it up once again, but it's the 170,000 plus the 198,600. And then we'll divide those two out. Similar calculation, but don't get them quite mixed up because we're comparing, once again, the total liabilities to the equity, not comparing to total liabilities and equity, not comparing to the bottom line, but comparing the liabilities to the equity. And remember, the equity can be calculated as or thought of as assets minus liabilities, or the 512,740 minus the liabilities, the 61340 minus the 82800. That's going to give us our equity, which you can think of as kind of like the book value of the company. So we're comparing the liabilities to equity, or we're comparing 144,140 in this case divided by the 368,600, and that's going to be the 39%. So if you think about this ratio, notice that we want the liabilities, of course, to be as low as possible in relation to the equity, which is kind of like the book value of the company. And therefore, we would like this to be lower. And so in this case, A is going to be lower because we want the numerator to be as low as possible in relation or compared to the denominator and compared to the equity. Next, we'll take a look at times interest earned. Times interest earned is going to be the income before interest and taxes divided by the interest expense. You can see why this would be a common type of ratio for creditors. In other words, if we're going to loan the company money, our goal is to see, well, can they at least pay back the interest? That's what we're trying to say. I mean, if we loan the money, what we're trying to get is rent on the money. Can they at least pay the rent on the money, the interest on the money? To do that, the confusing part of this ratio is that we have to take net income, but net income already has interest expense in it. And what we're trying to do is see how many times over that interest expense could be paid. And therefore, what we want to do is take net income and add back the interest expense that had been deducted from it so that we can calculate that. And we're also going to add back taxes, or we're going to take the income before taxes in our calculation because we don't want to be including the taxes, because taxes kind of confuse things, because of obviously taxes always confuse things, but the taxes are going to be affected by the expense, and therefore they're going to kind of throw off our ratio analysis. So we typically remove the taxes, which will be affected by the expenses. We remove the interest, Then we consider how many times the interest could be paid over. We divide the interest into the net income, not including interest and expenses, and see how many times we could pay over the interest given the net income or the performance of the company over a certain time period. Let's take a look at an example. Got the balance sheet, we got the income statement, we got some prior year data. This is another one where you want to basically visualize how you're going to set up this table, because this top line item includes more than one number. So you kind of want to write that down. You want to log it down. You want to think it through so that if you have to recalculate it, you can go back to your calculators and run through it. So we're going to start with the net income. So we have the net income number. Note in our case, we have a net income number down here and don't have a subcategory for income before taxes. Many times financial statements will already have a line item that says income before income taxes, just because some calculations do have this kind of problem, just because net income does throw off calculations and mess things up, or the taxes throw off calculations and mess things up. Therefore, they often have that breakout. If we have that, then you can just start with income before taxes and not have to add back the taxes. If we have a tax expense calculated but no subcategory, we can start with net income and then add back both the income tax and the interest income. So we're going to say, I don't want income tax included in the calculation of net income. In other words, I want net income before income taxes, and we want to add back the interest expense because we want to take that out at the beginning and then divide in the interest expense to see how many times we could pay it over. That'll give us our subcategory. So we took the net income, we took out the income tax, we took out the interest expense on the income statement. These are the numbers we took out here. And that'll give us our subtotal, which you could call, of course, income before interest and taxes. We have the top line item now, and then we're going to divide that by the interest expense, which of course is the same number here. The reason we took it out is because we then want to divide it back in to see how many times we can divide the interest expense into the income before interest and taxes, in our case being 22.3 and 13.7. So going through these calculations one more time, we got the net income 164,508 plus the income tax 14992 plus the 8400 interest expense. That gives us the income before interest and taxes to 187.9. Then we're going to divide that by the interest expense, the 8400. We get 22.4 and 13.7. That means that we can pay over the interest expense 22 times with the income before interest and taxes. The higher this number, the better for the creditor, because they feel more safe that they're actually going to get the minimum return on their investment, the interest, the rent on the money, the interest on the loan. In this presentation, we will take a look at and calculate profitability ratios. When thinking about different types of ratios, we do want to be able to categorize those ratios so that we get a better understanding of what the objective of the ratios are, and so that if we're tested on these types of categories, we know what they are as well. These are common types of test questions to group the different types of ratios. We've taken a look in prior presentations at liquidity and efficiency ratios, solvency ratios. We're now looking at profitability ratios. When thinking about profitability, we're thinking about the company's ability to generate an adequate return on invested capital. In other words, we're thinking about a performance type of calculation. How are we doing given the resources, the capital that we have? The other category we'll take a look at in a future presentation is market prospects. Profitability ratios will include, we're going to have the profit margin, we're going to have the return on total assets, and we'll have the return on common stockholders' equity, the return on equity. Starting with the profit margin should be a common ratio that we have some familiarity with. It's going to be the net income divided by the net sales. So remember, whenever we see net income, we're talking about the bottom line in this case. Net sales, on the other hand, represents basically sales or revenue, the top line, not the net income. So net sales is going to be the top line. It's going to be net because it'll be net of any kind of contra sales account. So if we have a detailed income statement, we may then have the breaking out of the contra sales accounts of allowance and discount. It's net of those contra sales accounts, which aren't expense accounts, and therefore that gives us the total sales. And then we have the net income bottom line on the income statement. If we take a look at our data, we have the income statement for A and B here. We can consider them as two separate companies, two sets of data. We have our income statement. We're going to start off with the net income. Net income is going to be the bottom line, so the 164,508 and the 202,903. We're going to divide that by the sales. So this is going to be the top line. This is what we're generating, the revenue, minus all the expenses gets us down to the bottom line. We divide those two out and we get our profit margin. So if we were to calculate that with a calculator for A at least, it would be the 164,508 divided by the 780,000. And that's going to give us the 21.1 about. Note, we're always going to be having to deal with rounding. When we consider this ratio, we're looking at the bottom lines. That's the net income, what we're walking away with in essence, in terms of net income as compared to the revenue that we're generating. So if we think of every dollar of revenue, the net income is basically what we have left at the end. If we take a look at that ratio, the income, what we have left at the end related to the net sales, we can think of it as for every dollar, how much we're walking away with, 21 cents, 0.21 of each dollar of revenue. So obviously we want this to be higher. We want the net income, what we're keeping, what we're holding on to after expenses, to be higher in relation to the earnings, to the revenue that we have. So in this case, B is looking better than A with regards to the profit margin ratio. Next, we'll take a look at the return on total assets. Calculation is going to be the net income divided by the average total assets. So we're comparing here the net income. Now we're talking about the bottom line, not the net sales. So we're not talking about revenue. We're talking about the bottom line, what we're walking away with at the end of a time period. This is a timing account. This measures a time frame or period, a period of time, a beginning and an ending. And we're comparing that to the average total assets, which of course is a balance sheet account or balance sheet grouping of accounts. The total assets as of the end of the time period is when the assets are reported on the balance sheet, and we need the average then. So the average makes sense because we're trying to compare the average to an income statement account, which represents a total time period. Therefore, we want to pick up the average, which would be an average amount as of any given time period within that time period. So we're going to do that by taking the beginning balance plus the ending balance and dividing by. If we think about this ratio, remember that the net income is the net of what is happening, revenue minus expenses, and we're comparing that to the total assets. The total assets are what the company has, and the reason we have the assets is in order to help us to generate revenue, in essence, to help us to generate the net income. So we're comparing basically a performance account, net of the expenses, as compared to the average. How well are we, in essence, using our assets in order to generate revenue? What's the return on those assets? Let's take a look at an example. Here's our data. We have the balance sheet. We got the income statement. We got the prior year data. We're going to have to break this out. This is a longer type of calculation once again because we have the average down below. And remember, when we have the average, we're going to have to break out beginning and ending year. I would recommend visualizing a table, whether you do it in Excel or on paper, actually writing down each step rather than just punching it into a calculator for these mid steps, so that you can see each step along the process. If you actually physically write it out or put it in Excel, look at a table, you'll be able to visualize it better and be able to write it down easier when you have to with limited time. You'll also learn it better as well. So we're going to start off with the net income. That's going to be the 164,508. That's going to be the income statement account, the timing account, not the top line of the income statement, not the revenue, not the sales, but net income. Then we're going to have a subcategory to break out and calculate the average total assets. Average total assets is going to be calculated on the inner column here. So we're going to bring that inside so that we can do this sub-calculation that we'll then bring out to the outer column. It's going to start with beginning assets. That's not going to be on our financial statements. That's the ending assets. Where are we going to find the beginning assets? On the prior year financial statements, because the prior year financial statements represent the ending assets as of the prior year or the beginning assets for this year. So we'll take a look down here at the prior year information, picking up the total asset number. Then we're going to take the ending assets, which is represented on our financial statements because the balance sheet is as of a point in time, as of the end of the time period. Therefore, the ending assets will be picked up here. We're going to add those two up. Why? Because we want to take the average of them. We're going to add them up, divide by the number of items that we have, which is 2. So we'll divide that by 2. That gives us the 450, 370 for A and the 471, 275 for B. Then we can finally do our calculation here as it's shown in our ratio, that being the 164,508 net income divided by the 450,370, or in the 0.36 or the 36.5%. Remember that we're always going to have to basically be dealing with rounding. Many of these are not going to be even, and therefore rounding is going to be something we always have to consider and deal with. When looking at this, remember this is the net income. We want this to be as high as possible, and this is going to be the average total assets, what we're using, the resources we have in order to help generate the goal, which is basically going to be the return, the net income. So in essence, of course, we want this number to be higher. So the higher the number, the better we're looking here, because we want the net income to be high as relation to the average total assets, and therefore B is looking better than A for the return on assets. Next, we have the return on common stockholders' equity, and that will be calculated as the net income minus the preferred dividends, if we have any preferred dividends, and we're going to divide that by the average common stockholders' equity. This measures the company's ability to earn income for common stockholders. If we think about this calculation, the top line, of course, is going to be the net income statement number, or income statement number of net income. It's the bottom line of the income statement. This is a performance number because we're on the income statement. We're talking about how did we do over time in terms of net income, not the top line, but the bottom line, the income minus the expenses. We're going to subtract out the preferred dividends if there are any, because we're considering the return as it's related to the common stockholders, the normal type of stockholders, who we typically think of as the owners, and the preferred dividends then would need to be removed for that type of calculation. It's possible that the company doesn't have any preferred dividends, and in that case, of course, then we wouldn't have to deal with the preferred dividends calculation. So remember, the common stockholders is what we typically are thinking of, because they're typically considered as the normal type of owners of the company. We're then dividing that by the average common stockholders' equity. So in essence, we're dividing by equity, and we can consider what the equity is going to be the book value of the company, the assets minus the liabilities, or the amount of the assets that we're attributing to or have claim to by the owners, as opposed to a third-party liability. So we're comparing the performance of the net income, how did we do in a timing statement, to the equity section, the book value of the company, or the amount that's basically owned by the owners. In other words, you can think of it, the assets of the company that the owners have claim for, we are comparing to the performance of the company in terms of the net income over a certain time period. Because the equity section is going to be a balance sheet account, and the income statement is for a time frame, has a beginning and an end, as opposed to the end of the period on the financial statement, we are then taking the average, which will give us an average amount over a given time period, that same time period, the year. So in order to do that, we're going to have to take the beginning balance plus the ending balance, divided by 2. Let's take a look at an example. Here's our data. We're going to have our balance sheet up top. We got our income statement down below and some prior year data that will be necessary. This will be a bit longer of a calculation, of course. 1, because we might have that preferred dividend, but 2, because we have that average common stockholders' equity. Once again, once we do that, we want to visualize the table, because we can see there's going to be a lot more calculations than we're going to do than we can see in just the ratio that is typically given, and therefore we want to be able to write that out, consider it. The more we have down on paper, the more we can visualize it, the less likely we are to make a mistake or get confused, miss a step. Therefore, I would practice writing it down in a longer format. We're going to start off with the net income. I'm going to put that on the right side. The net income, of course, is on the income statement. It's the bottom line of the income statement. We'll subtract out preferred dividends if there are any. There are none in this example problem. Therefore, we'll subtract out 0 and end up with the subtotal, which is the same as the net income, or the net income minus the preferred dividends. Then we're going to pull into the inner column the average equity, calculating the average equity in that inner column. To do that, we're going to have the beginning equity. Where's the beginning equity going to come from? It's not on the balance sheet, because that represents the equity at the end of the time period. We want the beginning of the time period. Where's that going to come from? The prior year financial statement. Prior year financial statement represents the end of the prior year, and therefore the beginning of the current year. So we're going to take a look at the equity section for the prior year. That's going to be, in our case, the common stock, the 170,000 plus the 161,592 for A. That'll give us our 331,592. Then we're going to pick up the ending equity. That's going to be on our current financial statements. Here's our ending equity, which is going to be the 170,000 plus the 198,600. That's the for A, the 368,600. Then we're going to add those two together. We add those two together, we get the 700,192. Why do we do that? Because we want to take the average. How do we take the average? We got two numbers, we add them together, and we divide by how many numbers we have, which in this case is 2. That'll give us the average, which we're going to pull out to the outer column here. Going to pull the average back out to the outer column. And now we can do the calculation showing we have our two numbers that are in our calculation, the one being the net income minus the preferred stock divided by the average common stockholders' equity. Let's push that into the calculator now. We got the 164,508 divided by the 350,096. That's going to give us our 47% about. So remember, we're always going to be having to deal with the rounding. So note up top, we in essence have the net income. So we're starting with the net income up top. We're comparing that to our equity. Now note the equity represents the claim of basically the owners of the assets. So the claim of the owners of the assets, the fact that it's in the company and not being distributed to the owners is basically representing how much of their investment is still in the company. What we want to do is have as high a return as possible as compared to that equity in the company that the owners are basically having claim to and are keeping in the company. Why is it there? In order to help us to generate revenue, in order to help us to generate a return or net income. So in essence, we want this number to be high as compared to this number. So if we take the net income divided by the equity, we would want this to be higher. And so in this case, B is looking better than A, it having a higher return on common stockholders' equity. In this presentation, we will take a look at and calculate market prospects ratios. Remember that as we go through these ratios, we do want to keep in mind the grouping of the ratios because this is going to help us to understand what the ratios are used for in practice. And if we're taking test questions, it's a common test question to ask what type of group a particular ratio is in. In prior presentations, we've taken a look at the liquidity and efficiency ratios, the largest category of ratios, the solvency ratio, profitability ratio, and we are now concentrating on the market prospects ratio. We generally use the market prospects ratios for those kind of companies that are publicly traded because the publicly traded companies are typically traded on a public exchange, and then we have some more data with which to work. We can consider what the market is considering of these stocks. In other words, this is going to include information that's not simply on the financial statement, which is generated internally, but is also going to include information that's generated by external users through the market. So if we have a publicly traded stock, and it, for example, of course, we know the price of the stock or what it's currently traded for because it's being traded for at that price on the market. So we can take that consideration and we can use the market and say, this is how the market is in essence valuing the stock in some way, and use those market perspectives to help us to come up with ratio analysis for the company. Market prospects ratios will include the price earnings ratio and the dividend yield. We're going to start with the price earnings ratio. That's going to be calculated as the market price per common share divided by the earnings per share. So if we consider these two items, we've got the market price per common share. Remember, where are we going to get that? It's not on the financial statements. We can't report that internally because it's being determined externally. That's the point. It's being determined by the market. So if you have any questions on this for a test question, they're going to have to give you that basic added detail. In practice, of course, it's probably one of the things we know fairly well because this is the thing that people will follow quite often, how much a particular stock is trading for publicly at any given time. We're going to divide that by the earnings per share. So the earnings per share, we're basically saying how much of the basic net income, in essence, is being applied to each particular share, each particular owner being represented by a share, or a share representing one set value of the company. So the share, obviously the company is divided by an even number of common shares. We want to consider the performance of the company as it relates to the earnings per share, as it relates to the shares on a per share basis. This will be a bit confusing of a calculation because of this denominator having another type of calculation that we might need to consider, that being what are the earnings per share. If that's not given to us, we'll have to consider what that is. The price earning ratio measures market expectations for future growth because what we're comparing here is the market price that's being determined by the market. So the market's saying, hey, this is what we value this stock at. Why? Because we're actually trading the stock for that. It's comparing that to the earnings per share, which is basically internal type numbers, stuff that's actually on the financial statement, comparing the net income, what the company has earned in relation to the number of shares on a per share basis. So obviously the numerator and the denominator on a per share basis. Let's take a look at an example. Here's our data. On the left, we got the balance sheet, we got the income statement, we got some extra data, including prior year data. And then we're going to say for the purposes of this problem, the market price for both A and B is $100. So we're just going to take our market price, and again, I'm giving the market price because it's something that's not going to be included on the financial statement, $100. That would be currently what is being sold on the market for one share of the common stock of the company. We're going to say it's the same for A and B, and then we're going to compare that to the earnings per share. Now, the earnings per share is given to us here. We have the earnings per share. In essence, the earnings per share is going to be the net income that's going to be allocated to the number of shares. So if you were to calculate the earnings per share, you'd have to say something like, well, here's the net income. How many shares do we have? Well, up top, we might see something like this. We've got the common stock. It looks like it has a par value. It's given a par value. The par value means that we're allocating an even par value to this common stock, that being $5. So if we take this 170,000 and divide it by that 5, we're going to get 34,000. So we have 34,000. Remember that number, 34,000. And we have the 164,508 divided by 34,000, the number of shares, and that'll give us the amount we're going to allocate, in essence, the net income to the number of common shares that we have. In this case, we're not taking into consideration any preferred stock. We're just allocating the net income to the owners, the common stockholders, on a per share basis. And that's going to give us our 4.84. So then we can take that $100, 100 divided by the 4.84, and that's going to give us our 20.7 in this case. So again, let's consider this again. We've got the price. This is what, in essence, it's being paid for. People are paying $100 for one share. This earnings per share is the allocation of the net income. So that doesn't mean that the owners are getting that net income. It's not being paid to the shareholders in the form of dividends. It could, but it's up to the company whether or not they want to do that. But you would think that the value of the company would be increasing by the net income. That's what generally happens. The net income is going to be increasing the retained earnings. You would think that basically that earnings is increasing, in essence, the value of the company. So we're comparing what people pay for the company to the earnings per share of the company. So in other words, we can consider it as taking 20.7 periods, or in this case years. We're considering the periods to be years for the earnings per share to add up to the market price of the $100. So we would generally want this number to be lower. It might be more attractive to investors the lower this number would be, because that would be B, means that it would only take 19.3 time periods for the earnings per share to add up to the market price, which is the same $100. Next, we have the dividend yield. It's going to be calculated as the annual cash dividends per share divided by the market price per share. So we've got the dividends, this time not being the earnings per share. We're not comparing the earnings per share. We're taking a look at what is actually being paid out. And note, what is actually being paid out isn't directly tied to the net income, because the company can decide to hold on to that income and use it for future growth, or they can decide to distribute their earnings out to the shareholders in the form of dividends. That's really partially an internal decision for the type of company. If you're talking about a company that wants to keep growing and is still feeling like they need the capital to grow, people may invest in that company not because they're going to get a return on the investment immediately in the form of dividends, but because they think the company will grow by putting the dividends back into the company, increasing the share price of the company. So they're there for the long-term investment, not the immediate return of the dividends. So keep that in mind as you consider the dividend yield type calculation. It really depends on how you use the calculation with what your goals are for the investment. Do you want an immediate return on the investment, or are you looking for the type of company that's putting money back in so that you're getting more of a return in terms of the increase in the value of the company, expecting the company to have growth in terms of overall value of the company as opposed to the immediate return? We're dividing that by the market price per share. Once again, the market price per share is not something determined internally. It's something that's being determined by the market. So we're trying to say, okay, what does the market think in terms of the market price per share? How do we know what they think? Because they're putting their money down and it's on a free market. So we're comparing what the market thinks to the internal data in terms of how much is being actually distributed. Let's take a look at an example. We've got the balance sheet, we've got the income statement, we've got other data. We've got the dividend yield. It's going to be the annual cash dividends per share. This will be given financial data that will be coming internally from the company because it represents what the company is paying back to the owners, to the shareholder in the way of dividends. Note, however, that it doesn't have anything necessarily to do with net income. Last time we calculated the earnings per share, and some people get confused. It can often be confused that we would think that the earnings per share would be the amount that's distributed in terms of dividends. Not the case. They could distribute that, but the dividends are something that are going to be determined internally by the company, where they're going to say, how much do we want to distribute? Do we want to hold on this net income, hopefully generated retained earnings and assets up here? Do we want to hold on to those to help us to generate more income in the future, or do we want to distribute that money in the form of dividends back to the owners, those being the shareholders? We're talking here about the amount that actually was distributed back, which means that we probably have the income related to it, and then the company then determined how much should be distributed to the shareholders. Once again, this is on a per share basis, so we're talking about how much per share, not necessarily per owner, because we can own multiple shares, but per share. So we're breaking out the company into even components to shares. We're going to be comparing that to the market price, which once again is driven by the market. We're going to say that's $100, meaning people are actually paying on the stock market $100 for one individual share in this case. If we then do the division, if we divide this out, we're taking the 3.75 divided by 100, and that's going to be the 3.8%. We're always going to be dealing with rounding. If we think about this, we're going to say, okay, this is what we're actually getting back on our return. We're actually getting this back in terms of money. This is how much the current stock price is. So in essence, we want this number to be higher as compared to this number. So generally B would be better in this case because we want the actual cash back to be high as it relates to, as compared to the market price. However, again, this number is a little bit deceiving because it depends on the type of investing we're doing. If we're investing in a company that we want to get a return on investment, then of course we want an immediate return in terms of dividends. Then we want this number to be higher. There are many types of investments, though, where we might be happy with no dividends at all, and we're happy for the company to reinvest. Why? Because we're hoping that there's going to be a growth in the value of the company. In essence, if they don't take this net income and distribute it in terms of dividends and keep it within the company and are able to use it to generate more revenue, you would think that the price of the stock then would be increasing. You're voting on or betting on this number going up, the market price going up, because the market will then see that this company is reinvesting their money and using it hopefully wisely in order to generate more revenue in the future. In this presentation, we will take a look at financial statement analysis tools and data that can be found online. As we go through our ratios and other tools for financial statement analysis, it's important for us to understand those ratios so that we can interpret those ratios and calculate those ratios. It's also important to note, however, that there are many tools that can help us to calculate the ratios and even do some work in terms of the interpretation of those ratios. And there's also going to be industry data that we can find. There's going to be resources that actually compile industry data. Some of these will be privately held resources that you would have to pay for to get this data that's going to be comparing our information to industry standards. And you can find some resources that will be free that basically compile the industry standards. That's one of the major things that we would like to do with our data is say, how does our data line up to industry standards? Software can help us to do that because they can help us to calculate our actual ratios. It can calculate the ratios for the industry that is related to us, and it can do comparisons much more easily in that format. We're going to be taking a look at this URL website to see some resources that you can find for free online. We're currently at a University of Denver page. If we scroll down, we're at the company research industry analysis. We have the tools down here. We have some resources. So they've got some links to some resources. We're going to take a look now at the biz stats. So we're going to go to the biz stats. As we do so, you can see the URL up top, www.bizstats.com, bizstats.com. We scroll down and we see we have the free business statistics and financial ratios. BizStats is the home of free, accurate business statistics. we're going to look here to research for industry financial benchmark reports. That's what we want to do. We want to basically compare what we have to the benchmark type of reports per industry, the industry in essence standards. And the way to do that is, of course, a compilation of the data, the compiled data, then we can basically compare it to the standards with that information. We've got the corporations, we've got the sole proprietor, we can search by annual sales. We're going to go into the corporations. We can take a look at the industries. I'm just going to pick an industry. I'm going to pick construction as the industry. We continue further into construction. I'm going to say construction of buildings. And then we're going to go to the construction of buildings data. And we can see that we're going to get some of the industry data. Again, this is going to be the compilation of data. We've got 2013 construction of buildings data information here. So you can go through this information and take a look at how it is compiled. Note that when we take a look at industry standards, there's a lot of different ways we can compile the data, of course. So, and the different ways that we compile the data, who we include in the industry standards and who is excluded, or how specific the companies that we are including are, or how broad versus how restricted the categories we are using, are all going to be big effects on the industry standards. So when you think about industry standards, it's not something that's very cut and dry, because we're taking the average of many different industries and we can cut that average up into different ways depending on how we categorize that average. So note that the ratios themselves, we have fairly standardized types of ratios. When we calculate our own ratios, we're going to have fairly standardized types of calculations that are going to be standards that are used. When we think about comparing them to another company, one single company, then of course, if we can get their company ratio data, that's going to be fairly straightforward. We can benchmark to a single company. When we benchmark, however, to an industry, note that's not so straightforward, because we're doing some type of averaging process through the industry. And the way we average the types of companies that are going to be involved is going to have a big impact on the average that will result from it. In this presentation, we will take a look at a sample of a financial statement analysis report. We're going to go through the overview of that report. The information can be found at this URL. We are not associated with this URL. We're just going to take a look at it for example purposes. Here we are on the website. This is the URL. If you would like to go here, there's going to be other resources here. Some of them are paid resources. We're not associated with the site here. We're just going to use the sample report as an example. So we have our report information, a report on analysis of financial statements of Oshak Leyland. Then I'll let you take a look at the preface here if you so choose. We're going to scroll through. We can also take a look at the acknowledgement. I'm going to scroll through the acknowledgement here. You can see this at the website as well. We're going to scroll through to that. And then we're going to take a look at the executive summary. So we'll actually read through the executive summary here. Executive summary. The company has set itself the task of consolidating and enhancing its position in the Indian commercial vehicle market, both in terms of volumes as well as in customer satisfaction in the medium term. The company is executing various initiatives in terms of process and product improvements to achieve this goal. After 6 straight years of positive growth rate, domestic demand for, I'll skip the acronym, shows a decline during fiscal year 08 and stood lower by 2% year over year. Oshak Leyland also suffered a similar decline in its, I'll skip the acronym, portfolio. So we got the summary information up top. We've got the fourth quarter for 2007 as compared to the fourth quarter for 2008, and then we're showing the percentage change. So this is a horizontal analysis. And then we've got the fiscal year for 2007 as compared to 2008, and once again showing the change. And obviously, if we were to calculate this is a form of horizontal analysis that we have in the summary report up top. So if we take the latest quarter, the 25620, minus the prior year, the prior quarter. Now note here that we have the prior year first, and in our convention, in our examples, we typically were putting the current year first. So you have to be aware of course, which year is being displayed and what convention is being used in order to put the first year on the left or the prior year on the left. So we're going to subtract the current quarter, fourth quarter, 2008, and subtract minus the 22910 for 07 fourth quarter. That's the change. And then if you divide that by the prior quarter, the 22910, we're getting our 11.8% here. So that's going to be our percentage change in this horizontal type of analysis. So then we have some analysis, all segments and geographies combined, and then volumes for the full year remained flat. Here, apart from the passenger, sales of LCV and exports also helped prop up volumes. In value terms, growth stood at 8% year over year for the full year, thanks mainly to improved product mix and a series of price hikes that the company undertook during the fiscal year. So note they're giving some explanation here due to, we're looking at the percentage, and they're saying here's the percentage and here's what the reason of it is. And that's really going to be the part that you want to kind of take from a report such as this. It's not enough to just say, hey, here's the percentage, the numerator went up, the denominator went down. We want to be able to interpret it in actions, what actually happened. And that's the skill that needs to basically be developed as we dig into the numbers and then see what's actually happening. Income for vehicles was Rs 68,819, 4.1% over the previous year level at Rs 66,092. In addition, the company made investments in a vehicle manufacturing assembly plant at that location, design engineering services business, Defiance Testing and Engineering Services Incorporated USA and Germany, which is engaged in development of fuel emission treatment control systems. So that was our summary. Now we're going to go into the table of contents. Within the table of contents, we've got the preface, we've got the acknowledgement, we've got the executive summary, and then in chapter 1, we got the company profile, the about section, product range, and then we got the concept of financial statement analysis. What are we trying to do here? We've got the traditional performance evaluation techniques, and that includes horizontal analysis, vertical analysis, trend analysis. That's where we're basically concentrating most of our time here, or that's what we've been taking a look at. And then we have chapter 4, analysis of profitability. We've got our ratio analysis, and this is a profitability, analysis of profitability here. So we're categorizing these. Gross profit ratios, net profit ratio, asset turnover, return on asset, return on equity. Then the analysis of solvency, and where we have, of course, the debt and equity. We have the interest coverage ratio, and then the analysis of liquidity. And that's where we have the current ratio, the quick ratio, the debt turnover ratio, the average collection period, and the inventory turnover. Chapter 7, cash flow statement analysis. Chapter 8, recommendations and suggestions. So first we have a little bit about the company. So we've got Ashok Leyland is a commercial vehicle manufacturing company based in India. It is the second largest commercial vehicle company in India in the medium and heavy commercial vehicle segment, which market share of 28% 2007-2008. Ashok Leyland is a market leader in the bus segment. The company was established in 1948 as Ashok Motors with an aim to assemble Austin cars. Manufacturing of commercial vehicles was started in 1955 with equity contribution from a British company, Leyland Motors. Today, the company is the flagship of the, I can't pronounce that, a British-based and Indian-originated transitional conglomerate. Ashok Leyland is a technology leader in the commercial vehicle sectors of India. Its annual turnovers exceed USD 2 billion in 2007 and 8, selling close to around 83,000 medium and heavy vehicles in 2007-2008. Ashok Leyland is India's largest exporter of medium and heavy duty trucks out of India. It is also one of the largest private sector employers in India, with about 12,000 employees reporting in 6 factories and offices spread over the length and breadth of India. Over the years, Ashok Leyland vehicles have built a reputation for reliability, ruggedness, with use mainly due to the product design legacy carried from British Leyland. In the populous Indian metros, 4 out of the 5 states transport undertaking buses come from Ashok Leyland. Some of them, like the double-decker and Vistable buses, are unique models from Ashok Leyland, tailor-made for high-density routes. In 1987, the overseas holding by Leyland Rover, Leyland International Holdings, was taken over by a joint venture between, I can't pronounce that, the non-resident Indian Transitional Group and another area part of the Fiat Group and Europe's leading truck manufacturers. This resulted in Ashok Leyland launching the cargo range of trucks. These vehicles used Iveco engines, and for the first time, AL vehicles had factory-fitted cabs. The cargo trucks are now longer in production, and the use of AVAC engine was discontinued, but the cargo cap continues to be used in the range truck. Ashok Leyland also has a collaboration with Hanu Motors Japan, from whom the technology for the H-Series engines was bought. Many ingenious versions of H-Series engines was developed with 4 to 6 cylinder and also conforming to BS2 and BS3 emission norms in India. These engines proved to be extremely popular with their customers, primarily for their excellent fuel efficiency. Most current models of Ashok Leyland come with H-Series engines. In the journey towards global standards of quality, Ashok Leyland reaches a major milestone of 1993 when it became the first in India's automotive history to win the certification. The more comprehensive certification came in 1994. So, and I'll keep going from there. So just note we have the summary, of course, of the company. We want to have an idea of the company. And as we do get the idea of the company, if we're reporting this to outsiders or if we're thinking about it ourselves, that'll give us an idea of who we can compare this company to. What are the industry standards that we can compare the company to? We've got the branch office. We've got the management team here. We won't go through all the management teams. We've got the achievements. So we're listing the achievements. We're scrolling through the products. Here's going to be a list of the products that we have. The goods segments, we have the list, and then we're going to go to the concepts in Chapter 2. We'll read over some of the concepts here because this should relate to our topic. We're going to have the financial statement analysis, objectives, assessment of the firm's past, present, and future financial conditions. That's going to be what the analysis is. Done to find the firm's financial strengths and weaknesses. That's what we're looking for with this type of analysis. Primary tools, the financial statements, and the comparison of financial ratios to past industry sector and all firms. So in essence, we're going to take a look at those ratios. We're going to probably be taking a look at, we will be taking a look at the horizontal analysis, the vertical analysis. We've already taken a look at a horizontal analysis, and then we'll take a look at some of the ratios and see what that can tell us about the company's past and present, and hopefully future. We can get some insights to that. Financial statements, we got the balance sheet, income statement, cash flow statement, statement of retained earnings, source of data, annual reports via mail, SEC, or company website, published collections of data, investment sites on the web. Techniques of financial statement analysis, we have the horizontal analysis, vertical analysis, trend analysis, and ratio analysis. So those are our standard types of analysis that we have in the report here. Horizontal analysis, this technique is also called as comparative analysis. So we can have comparative analysis. We're comparing year over year or period over period. Horizontal analysis, it is calculated amount of change and percent changes from the previous years to current years. Trend analysis, it is carried out by first assigning a value of 100% to the financial statement item in a past financial year used as a base year, and then expressing financial statement items in the following year as a percentage of the base year value. So that's going to be our trend analysis. We have multiple years. We're going to take them all back to the base year. And then we have our vertical analysis. Vertical analysis, cross-sectional, common size statements. So these are similar terms, of course. Came from the problems in comparing the financial statements of firms that differ in size. And so they're addressing the primary use of this type of financial statements. If we want to compare our financial statements to others, which have different dollar amounts, then we can use the type of vertical analysis, cross-sectional, or common size type of analysis. In the balance sheet, for example, the assets as well as the liabilities and equity are each expressed as a 100%. Each item to these categories is expressed as a percentage of the respective totals. So we're going to be taking a relation of every category to total assets, total liabilities, and equity. In a common size income statement, turnover is expressed as 100% of every item in the inventory statement is expressed as a percentage of turnover sales. So we're going to be comparing on the income statement everything to sales in our vertical analysis. From the vertical analysis, an analysis can compare the percentage markup of asset items and how they have been financed. The strategies may include increase, decrease, the holding of certain assets. The analysis may also well observe the trend of the increase in the assets and liabilities over several years. And then we have the ratio analysis, the objective of the ratio analysis. standardize financial information for comparison, evaluate current operation, compare performance from past performance, compare performance against other firms or industry standards, study the efficiency of operations, study the risk of operations, and then we have the rationale behind ratio analysis. Why do we do the ratio analysis? A firm has resources. It converts resources into profits through production of goods and services, sales of goods and services. Ratios measure relationships between resources and financial flows. So they're going to be comparing these things, which will give us information. It shows ways in which firms deviates from its own past, other firms, the industry, all firms. So we can basically use ratio to make these comparisons from its past, its own past, to other firms, to the industry as a whole, or to all firms. Ratios can be classified into the following categories. We have the categories of ratios. They have three here: profitability ratio, liquidity ratio, solvency ratio. Note, we're not thinking about market type ratios. We're not taking into consideration market characteristics because this is the internal report, and we're not considering things like a market price, which aren't included in the data of the company. Profitability ratio. Profitability ratios measure the overall performance of the firm by determining the effectiveness of the firm in generating profit and are calculated by establishing relationship between profit figures on the one hand and sales and assets on the other. Return on total assets. This is measure of profitability from a given level of investment. It is an excellent indicator of overall performance of a company. It is also called return on capital employed or return on investment. It measures how efficiently the company is employed. And then we have the formula here. We have the return on equity. It measures the profitability of equity funds invested in the firm. It is regarded as a very important measure because it reflects the productivity of the ownership capital employed in the firm. We have the formula here. Solvency ratio. The capacity of a company to discharge its obligations towards long-term lender indicates the financial strength and ensures its long-term survival. It is important for an analyst to study the solvency of a company. We have the debt coverage ratio. The ratio measures the capacity of a company to pay the installment of a principal due and the interest liability it has incurred on its long-term borrowing out of cash profits. It also known as the times debt covered, service covered. So we have the debt coverage ratio. Here's the formula. The interest covered ratio. The ratio measures the capacity of a company to pay the interest liability it has incurred on its long-term borrowing out of its cash profits, also called the times interest covered. Here's our ratio. We have the liquidity ratio. Liquidity is the ability of a company to meet its short-term obligations when fall due. A company should have enough cash % other current assets which can be covered convert to cash so that it can pay its suppliers and lenders on time. Current ratio indicates the firm's ability to pay its current liabilities, i.e. day-to-day financial obligations. It shows the strengths of the credit, strength of working capital, and capacity to carry on effective operations. In this presentation, we will continue taking a look at our sample financial analysis report, this time taking a look at the traditional performance evaluation techniques section of the report. That will include the horizontal analysis, the vertical analysis, and trend analysis discussion. Here we are on Chapter 3 of the report. We have the traditional performance evaluation techniques. We'll start off with the horizontal analysis of the balance sheet for the year 2008 and 2007. So here we have our information. We're going to concentrate here on the calculations that we have. So we've got the 08 and the 07 numbers, and our calculation for the horizontal analysis, remember, is the calculation period over period. In this case, year over year. We have the dollar change and then the percentage change. So here we have the dollar change is going to be equal to the current year, the 1330.34 minus the 1323.87. That's going to give us our 6.47, and we'll divide that by the prior year, which is the 1323.87. And that's going to give us, if we move the decimal point over, the 0.49. So you can see how this horizontal analysis is basically breaking out in that format, doing the year over year type of analysis through the accounts on the financial statement for the balance sheet. We also have a graph of the horizontal analysis 2008 and 2007. And we have the horizontal analysis of the income statement. So again, same kind of properties that we're going to have here with regards to the income statement. We've got the 2 years that we are comparing, 2 periods, 2008, the current period, last period, change in dollars, change in percentages. So we'll have the same type of calculation. We'll take the current period, 77291.23 minus the 71681.76. That's going to give us the change of the 5609.47. If we divide that by the prior year, which is 71681.76, that's going to give us the 7.83%, and that's going to be the change of our calculations for the intercompany. So we're talking year over year change, horizontal type analysis. We also have the graph of the income statement for the horizontal analysis here. You can take a look at the graph. Next, we're going to have the vertical analysis. So we'll have the report with the vertical analysis. Here's the vertical analysis of the balance sheet. And remember here, we're comparing everything basically to the totals. So although we have the 2 periods, we're comparing not horizontally period to period, but we're comparing vertically. So in this case, we're going to take the 21489.82 divided by the total, which is the 32903.03, and that's where we're getting our 65.31. And we'll do the same type of calculation for 07, and we have 06 and 05 lined up here as well. Again, we're not comparing year to year. These aren't comparing any of the numbers between these columns. They're comparing vertically within these columns, the common size type of statement. We can also, of course, show a graph in that format because in essence, what we're doing is breaking out the components to the total, which is a perfect kind of pie chart type of calculation. So we have the vertical analysis balance sheet for 2007, 2006 on the pie. Then we have a trend analysis of the balance sheet, and we can also graph the trend analysis of the balance sheet. So we have the sources of the funds here, shareholder funds, loan funds, and then we've got the trend analysis of the balance sheet application of the funds. So we have the fund analysis here, fixed assets, current liabilities. In this presentation, we will take a look at ratio analysis for profitability as we continue on with our financial analysis sample report. Here we are in Chapter 4, Analysis of Profitability. Profitability ratios. To analyze the profitability of a company, profitability ratios are used. These ratios measure the operating or income performance of a company. The goal of a business is to make a profit. So this type of ratio examines how well a company is meeting that goal. The commonly used ratios to evaluate profitability are gross profit ratio, net profit ratio, return on asset, asset turnover, return on equity. So here is our information. Profitability ratio analysis. Now we're not going to go through each of the calculations of the ratios, so you can go through here if you would like to take a look at the financial statement to recalculate the ratios, but we want to take a look at the way it's displayed and then any analysis we have on the ratio. So we got the gross profit ratio, gross profit divided by the net sales times 100. And if we go down to the analysis here, and again, you could go through and you can calculate the ratios for yourself and get some practice with that. We're going to go down to the analysis. The GP ratio is showing continuously decreasing trend starting from 2004, 2005 in 28.91% to 23.79% in the financial year 2006-07. This shows the company is losing its productivity in maintaining its gross profit margin. In 2007-08, the ratio again slightly been increased from 23.79 to 25.42. So note what the analysis is trying to do there. It didn't just say, which is where most people will want to start, hey, look, the numerator went up, the denominator went down, or something like that. And that's going to explain what happened, right? We're trying to get more insight and detail into that. We want to basically see the math and say, okay, this is why it went up or down, given the math, and then tell us what that means in terms of the weakness. Notice it's basically still pretty broad what it's saying here. It's saying there's a trend, but it doesn't tell us really exactly why. We can dig down deeper and say, well, why is that happening? And then start to dig down. So just note as you go through these ratios, you want to basically know if it's going up or down, is that good or bad? That's just basics though, that's the beginning. And then you want to go in and say, well, what's the type of trend that this might be telling us? What group are we talking about? And then get into the specifics as to what changes did the company make for this type of trend to be happening. So then we have the net profit. So net profit calculation, we're going to go down, once again, you can calculate it again. We're going to go down to the analysis. The NP ratio is showing declining trend from 6.49 in the year 2004-05 to 6.07 in the year 07-08, which shows there is an increase in amount of expenses in the form that increasing in the prices of the raw materials. So again, note how the explanation is happening here. It goes to why it's happening, increasing prices in the raw materials. Then we got the asset turnover ratio. We got the net sales over the average total assets. Again, you can go through and calculate that for the years using the financial statements provided. We'll go to the analysis. This ratio measures how efficiently a company uses its assets. The asset turnover ratio is decreasing, although the return on assets for the year 2008 is highest, but the asset turnover ratio is least for this year. The company is not using its assets optimally. So again, we have the analysis pretty broad there. It's not using the assets optimally because of the ratio that's being shown here. So that basically just says, hey, we know which way the ratio is going. We know what the ratio means. Again, we can obviously ask why. Why is that? What happened? It can give us some specifics as to how they're not using the assets optimally and ways for improvement. So there's always ways that we can dig down deeper into what these ratios are basically telling us, other than, well, this is good, this is bad, the ratio went up, went down. Next one, return on assets, profit after tax, average total assets times 100%. Let's take a look at the analysis. The ratio is used to measure a company's success in using its assets to earn income for earners and creditors, those who are financing the business. There is a steep fall in the year 2006 after there is a satisfactory utilization of the assets, as the graph shows. So again, it's kind of telling us the direction, which means we know what the ratio means, we know what it's doing, and we can tell you what the trend generally is. We can always go in further and say, well, why is that the trend? What is going on here? Then we have the return on equity. Again, you could do that calculation. Let's take a look at the ratio. The ROE of the company is 42.46 in 2004 and 5, which has been decreased 17.60% in 2006-07, and then slightly increased 23.21% in the 2008-07. Also, one point here to be noted is that ROE of the company is higher than the ROA, which may be due to the concept called trading on equity. So this is pretty vague. So notice we have the analysis here. We're trying to break this down. If you were to critique this, you might say, it's kind of vague here. We could break that down a little bit in more detail, which is always, you pretty much always can. You can dig down into these ratios and say, well, why is this happening? If there's a significant change, we know it's increasing or decreasing. Is that significant or not? If it's significant, we want to be able to tell more than, well, this went up, this went down. That's generally good. That's generally bad, because this is what that performance measure measures. We want to dig down to those specifics and say, well, what is happening? Why are these things happening? What are these ratios actually telling us in terms of what the company is doing? Has anything changed? Have the conditions changed? In this presentation, we will continue on with our ratio analysis, this time taking a look at solvency ratios within our financial analysis sample report. Here we are in Chapter 5, Analysis of Solvency. We've got our information. We're going to go into the analysis. We have the solvency ratio analysis in terms of a chart. Then we're going to take a look at the debt equity, the loan funds divided by the total shareholders. And note, we're not going to go into the calculations here. We're basically going to look at the formula, look at the data, and then we're going to go to any information that they provide on it in terms of analysis. So here we have the debt to equity ratios. If we consider the analysis we have, this ratio is used to compare the amount of debt a company has with the amount of the owners have invested in the company. It compares the amount of creditors' claim to the owners' claim to the assets of the firm. Trend shows that in 2005, the company was highly leveraged, but after it has managed to control this ratio in the year 2006 and 2007. So we have the basic trend here. We're saying highly leveraged, which means that we have a lot of liability as compared to the equity in that case. So we're leveraged on the firm. So that could be considered, in essence, a bad thing. And then we see the trend taking control, or less leverage happening, meaning more being controlled by the equity as opposed to the liability. Now note that they're noting the trend once again, but not a whole lot of detail as to why. So why were we highly leveraged? And, why did the trend stop? What changed? And that's what we would want to get more detail in if we were looking at these in a very detailed way. Note the software can give this kind of generic type of answer. The software can say, here's the trend, here's what it means, and here's what that generally means. It was looking highly leveraged, and then it became less leveraged at this point. That's all the software can do. In order for us to dig deeper, we have to say, well, what kind of changes, what decisions were made that actually resulted in that to be happening? And that's the further analysis that we typically would want to get into. Next, we have the interest coverage ratio, the profit before interest and tax divided by the interest expense. Here we have the ratios and the analysis. This ratio suggests that whether a company manages to earn sufficient income to cover its expenses. The ratio of the company indicates the company depends much on borrowed funds. The high interest ratio means the company depends more on debt funds. So again, the analysis is going to be pretty vague here. We might want to go into, what is this telling us? Why would we be dependent on the debt funds? And if we were a creditor, we're basically looking into thinking about, well, how many times can they pay over in essence, the interest earned? How likely are they going to be able to pay the interest expense given the profit of the company? In this presentation, we're going to take a look at ratio analysis for liquidity ratios within our sample reports for financial analysis. Here we are on Chapter 6, Analysis of Liquidity. Here's going to be some information for that. We got the liquidity ratio analysis. So we have some charts related to liquidity ratios. We're going to scroll down and go through those ratios. We're not going to go through the calculations one more time, but we're going to go through the analysis of it and see how it's formatted within our report. We have the current ratio first. We got the current assets divided by current liabilities. Here's the calculations. You can calculate them yourself if you would so choose. For practice, we want to take a look at the format and the analysis, which is this ratio is used to measure a company's ability to pay current liabilities with current assets. This ratio helps creditors to determine if a company can meet its short-term obligations. The gradual decrease shows the company's liquidity has worsened. The company should rethink over its credit policy. So again, note here, we have a pretty broad type of thing. This is something that the software can do. If we have software to calculate these ratios, it can basically say, hey, this is what the ratio is. Is it good or bad? The trend, it looks, not good in this case, and there's the trend. Doesn't tell us why, right? It says that we should rethink the credit, but it doesn't really tell us really what is going on in terms of why the trend is happening. And we would, in practice, want to take a look at more detail for the particulars of the company and say, why is this happening? Why is this trend happening within this ratio in terms of decision-making policies of the company, and whether or not those decision-making policies are good and effective, even though the ratio is telling us what they're telling us. It's supposed to give us some guidance as to actual decision-making policies and what we can do about it. Then we're on the quick ratio. Quick ratio, current assets minus inventories, or basically quick assets, divided by the current liabilities. Here's the calculation. We'll go down to the analysis. This ratio is used to measure a company's ability to meet its short-term obligations. This ratio is similar to the current ratio. However, by limiting the numerator to very liquid current assets, it is a stricter test. It is often called the acid test ratio. The quick ratio is worse than the current ratio. This means that the current ratio was because of inventory. The liquid asset other than inventory of the company needs consideration, attention. So again, here we got some analysis here to tell us what the difference is, and note they were able to pull out and say, hey, we could tell part of the difference is due to inventory, because inventory is something that is not in the quick assets while it is in the current assets. So the software could basically make that determination. However, what the software can't do too well is to basically say, well, why is that happening? Again, what are the decision-making things that are leading to this trend in terms of policy decisions related to these items? To break those down, we'd have to go into the actual decisions that are making the changes that are happening. Then we're going to go to the debtor turnover ratio, sales divided by average debtors. You can see the calculation here. Analysis. This ratio indicates the number of times each year the debtor turns into cash. It shows the effectiveness of the firm's collection and credit policy. The high ratio indicates the ability of the firm's collection of cash from the debtors. The trend of past 3 years indicates that the firm has managed to improve its credit policy. So that's great. Tells us what it is, tells us what the trend is. It's looking better. Again, if it's significant to us, we might want to say, well, why is it getting better? What are they doing that's good? How can we continue to do that good thing, or praise the people that are doing that good thing, and further encourage whatever changes have been made in order for that to happen? Or is it economic conditions? Just simply economic conditions have changed, and therefore there is an improvement. We want to be able to look more intuitively into action plans that we can do, or action plans that the company is doing which means that they're improving. Next one, we have the average collection period, average debtors, divided by sales over 360. If here's going to be our calculations. We'll take a look at the analysis. This ratio shows the average collection period is going lower from 37.21 days in the year 2004 and 5 to 20.93 days in 8 and 7. It means that lower capital is getting blocked up from 0405 to 0807. It shows the improvement in the credit policy of the company. So again, improvement in the credit policy. We see improvement happening. You know, what is that improvement? How did they do that? How did they actually improve in that? What actions did they take that led to that improvement, if any, or is it an economy type of thing? Then we have and again, I'm not trying to criticize these reports when saying that. This is basically what the software can tell us, but there's limitations to the software in terms of interpreting the reports with regard to actual action plans, which is what, you know, we need to do with the report, further analyze and look at those action plans. That's where we get the real information that we can act on from. Then we have the inventory turnover ratio, cost of goods sold divided by the average inventory. There's our information. Going down to the analysis. This ratio is used to measure how quickly a company is selling its inventory. This ratio tells how many times each year a firm's inventory is turned over. The inventory turnover of the company over the period of 4 years has remained stable, more or less. So this is one where we're saying the trend is pretty much constant. Maybe we don't need to do a lot more digging into it because it's constant. There is no change that's happening. If it's a current trend that we think is pretty good, then we might want to just basically keep it constant for it. There's no big change that we would need to go in there and say, what did we do different? We might think, what can we do different in order to make a change for the better? In this presentation, we will take a look at the recommendations section of our sample reports for financial analysis. The recommendations section should give us some idea of some action plans. Take this ratio, summarize it up in terms of recommendations with regards to the analysis that has been made. This is probably one of the more difficult items to do within the analysis. Remember, as we've seen, when we look through these analyses, we could say, hey, this is the ratio, this is what it's supposed to do, and this is the trend in accordance with what the ratio should tell us. And that's what the software should do. And then we need to take that information typically and go into more detail in it and say, well, what is this telling us in terms of our particular company? That's a bit more difficult. That takes more insight. That takes something more than just simply automation in order to put something into a system for the system to be able to calculate something like calculations. It's something that can't be done by something that would be similar to a calculator or a computer. It takes more analysis about the company in order to do so. So we'll just read through the recommendations here in our sample report. Ashok Leyland is a second largest manufacturer of medium and heavy commercial vehicles in India. It had 24% market share in the domestic medium and heavy vehicles segment of the fiscal year 07 and marginal presence in the LCV segment, light commercial vehicles. Ashok Leyland is also a key player in the passenger bus segment, with almost 49% share of the fiscal year 07. CVs continued to 92% of revenues in fiscal year 07, while engines and spare parts contributed to the balance. Transportation a structural change. The CV segment in India is going through a structural shift with the government's thrust of road development projects. Road sector has gained significant advantage over railways that has been mainstay for transportation of coal, food, grain, and cement till now. If one considers the trends of the developed nations, almost 2/3 of the non-bulk goods are transported through roads. The completion of the Golden aimed at connecting 4 metros and the east-west north-south corridor will result in availability of a network of 12,000 kilometers of connectivity. This will give a major fill-up of road transport. Bus segment is a growth story. The bus segment has the potential to witness the expansional growth witnessed in good commercial vehicle during last 3 years. We agree with the view of the management about the potential that the bus segment has. Our belief stems from the fact that straight transportation are operating at significantly high utilization levels, 120% to 130% of their capacity, though the STUs are facing resource crunch due to a number of reasons. We believe the renewal of fleet is an evaluationary in long-term run. Aggressive expansion plans. In order to cash in on the industry growth story, the company has lined up an aggressive expansion plan whereby it will be more than doubling its capacity over the next 2 to 3 years by making an investment in the region of Rs 440. Included in the expansion plan is a brand new integrated plant for 50,000 vehicles per annum in the state of whatever state that which will not only help to save a transportation cost, but will also provide certain fiscal incentives. Sector. The growth of the auto industry is directly linked to the growth in the industrial activity, which in turn is a function of the domestic GDP growth. Given the projected strong economic growth in the country, the CV sector is likely to witness robust growth rate in the long term. Sales. Net sales of the company have averaged Rs 46 in the last 5 years and are expected to climb higher given the long-term growth prospects of the economy. Current ratio. Ashok Leyland average current ratio during the years 03 and 07 has been 1.5 times. This indicates the company is comfortably placed to pay off its short-term obligation, which gives comfort to its lenders. Due to debt-to-equity ratio, a highly leveraged business is the first to get hit during times of economic downturn, as companies have to consistently pay interest costs despite lower profitability. By believing that a debt-to-equity ratio of greater than 1 is the high-risk proposition. Considering Ashok Leyland's average debt-to-equity ratio of 0.6 over the last 5 fiscals. Long-term earning per share growth. We expect the company's net profits to grow at a compounded rate of around 8% over the period fiscal year 08 to 10. Based on normal scenario, we consider the historical compounded growth of over 20% in net profits over a 5-year period as healthy for a company. Margin of safety. This is to determine the value of the stock related to its price and the returns over the risk-free rate. Margin of safety of a stock lies in its earning power, which is calculated as EPS, earnings per share, divided by market price. Considering Ashok Leyland's PE of 10 times its trailing 12-month earnings, the earnings power is 2%, which is fairly low. Valuations. Ashok Leyland is currently trading at Rs 13, implying a PE multiple of 4.40 times. Based on valuation criteria, the sell limit for the stock as fiscal year 10 cash flow comes around Rs 50 per share. This implies a point-to-point upside of 43%, or alternatively a CAGR of 18% from the prevailing share price. Thus, at the current juncture, investors could do well to buy the stock from March 2010 perspective. So note we have within the recommendations, we got some summary about the actual company, and then some predictions that are taking information from the ratios, but also applying them to the company itself, also taking into consideration past performance as well as future performance, as well as economic conditions and basically averages for the market, and pulling those things together in terms of trying to put together a summary information based on the type of analysis we have, as well as possibly market conditions, segment conditions. In this presentation, we will take a look at how to find financial statement data online. In other words, if we would like to practice our ratio analysis, applying our ratio to actual data for actual companies, we can look up the company data typically online. There's a lot of data that can be found online for particular companies. If we're looking at publicly traded companies, then we'll typically be able to find that data fairly easily online by simply going to their website, looking up the financial information, and then we can use our analysis with regards to that data. For an example, we'll take a look at Coca-Cola. So if we pick Coca-Cola and we're going to say, okay, we want to apply our ratio analysis tools to Coca-Cola, then we can look up their information. Now, obviously, this is going to be a large company, and therefore the financial statements, we want to keep that in consideration. But if we pick a company that's going to be publicly traded, then typically we'll be able to find their financial information. So I'm just going to look up here the Coca-Cola. I'm looking up the official site, and we're just going to basically go from there and see what we can find. So here's the Coca-Cola company. This is the home page. So we'll go to the Coca-Cola Company homepage, and then we're looking for investor information somewhere. We're trying to look on this homepage and say, okay, where can I get the financial statements? Obviously, most websites will have a search field. We could search financial statements, but we may also have something pretty clear they can find it. On this case, we have the investors. That looks like what we're going to want. So we can go to the investors and say, what type of information do we have here related to the financial statements? And we could scroll down through here and say, all right, what kind of information do we have? I'm going to think about the annual report. So we've got the annual reports, we've got the quarterly reports, we've got the earning releases. I'm going to look at the annual reports because we're looking for the financial statements in order to apply our ratio analysis in that format. As we go through the financial statement information, we've got the annual report for 2018 dated 2/21/2019. So if we select that item, here we have it, the United States Securities and Exchange Commission. We have the Form 10-K. Let's just take a look at the table of contents to see what will be included in the report. Most of our analysis is obviously going to be on the financial statements, the income statement and the balance sheet primarily. Let's see what we have here. We've got in part 1, the business. We have risk factors, unresolved staff comments, properties, legal proceedings, main safety disclosures, executive officers of the company. Then we have part 2, market for registrants, common equity, related stockholder matters, and issuer purchases and equity securities, selected financial data. So we have some selected financial data here, not the financial statements particularly or per se. We have the management discussion and analysis of financial condition and results of operations. So obviously the management will give us the analysis. We would expect that to be a fairly good spin on the analysis. Of course, this is the internal management reporting on the analysis, but we can have some good insights with regards to the analysis, and we can try to compare that to the ratios that we come up with. We can say, hey, here's our ratios. Does the management's discussion and analysis kind of line up to what the ratio seems to be pointing at? Quantitative and qualitative disclosure about market risk, financial statement, and supplementary data. This item is, of course, where we want to spend most of our time because we actually have the financial statements and supplementary data. So we're going to be jumping to item 8 after we go through the table of contents here. Changes in the disagreements with the accountants and accounting and financial disclosures, controls and procedures, other information. We got part 3. Directors, executive officers, and corporate governance, executive compensation. So we actually have the compensations of the executives if that's something you want to take a look. Securities ownership of certain beneficial owners and management and related stockholder matters, certain relationships and related transactions and director independence, principal accountant's fees and services. So if you want to see the accountant fees and services for Coca-Cola, you can take a look at that. Might be interesting to some folks in the accounting field. Exhibits and financial statement schedules, Form 10-K. So here we are in the financial statement and supplemental data. We have the consolidated statement of income, the consolidated statement of comprehensive income, the consolidated balance sheet, and the statement of cash flows, the statement of shareholders' equity. So this is going to be, of course, our financial data. And so if we want to apply our ratios to some data, we can go to the financial statement data here. We've got 2018, 2017, 2016, this being the consolidated statement of income, in essence, the income statement here. So we got the net operating revenues, the cost of goods sold, the gross profit, so on and so forth. Next, we're going to have the consolidated statement of comprehensive income. Then we're going to have the consolidated balance sheet. So we've got the assets, liabilities, and equity on the balance sheet. And then we're going to have our consolidated statement of cash flows. So this information is available and it's fairly easy to find on most company websites which are publicly traded. So if we're talking about a publicly traded company, you want to check out their financial statements, you could typically just simply go to their website, look at the investor information, look for that investor information, and typically be able to find their financial statements fairly easily and use that information for your ratio analysis.